Up from blue sky projects to the bottom line. We'll speak with our Bloomberg NEF expert Meredith Annex and dig into their models about how hydrogen fits into the future energy mix. This is Bloomberg Green. From Bloomberg's World Headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. Now let's bring in Meredith Annex, our Bloomberg NEF hydrogen specialist, to talk more about how hydrogen could change the energy landscape. So Meredith, what place do you think hydrogen is likely to have in the future energy mix globally?
Hydrogen's this incredible solution for us as we look to decarbonize because it's a perfect solution in areas that are hard to electrify. So where we like to think about hydrogen playing a role, it's in things like heavy industry, especially where you need a feedstock as well as energy source, and in things like dispatchable power, long-haul transport, maybe even shipping and aviation.
That sounds great that it can be used for such diverse industries. At the end of the day, though, how much is this going to cost?
Well, that's the amazing thing about hydrogen, because depending on how you make it, it can actually see significant cost declines in the future. So when we're talking about clean hydrogen, we usually mean green hydrogen produced from renewable electricity. And in that case, your hydrogen is almost as cheap as the renewables that are used to make it. So if you're in a place with really good renewable resources, you'll be able to have cheaper hydrogen. But even in places with less good resources, we think that hydrogen can be cheaper than $1 per kilogram, which is the price of unabated hydrogen today, and around $8 per million BTUs for those who prefer to think in energy units. And that can be achieved anywhere in the world by 2050, we believe.
All right, so let's talk about kind of the pros and cons list. I don't know where cost fits into that, but what are the advantages to hydrogen over other renewables, and then what are the drawbacks?
Yeah, main advantage is the fact that hydrogen can serve roles that electrons struggle with. And that's things like seasonal storage, for instance, or just anything where you need storability, where electrons are harder to store, hydrogen is going to be easier. That also leads to a downside, though, because hydrogen is less energy dense than the usual things that we use for storable energy today, like coal or oil or natural gas. So you will need more volume of storage to handle the same amount of energy.
Let's talk about the viability as well and how it may differ in different geographies. What is your view on that?
Yeah, so for green hydrogen, again, from renewable electricity, really places with the best renewable resources, things like Latin America or the Middle East, even Southern Europe, have really, really good potential for producing hydrogen. And then when you're looking at blue hydrogen, which is produced from natural gas or coal with carbon capture and storage, we do see that becoming more expensive than green hydrogen in the future, especially as renewable electricity costs come down. But that can be a viable option in places like the US Gulf Coast or Russia, where you've got good geological storage for the carbon, as well as ample natural gas that's quite cheap.
All right, great breakdown. Thank you so much to our Meredith Annex, our Bloomberg NEF hydrogen specialist. And of course, you can get more from the Bloomberg NEF team on the terminal and online. And they've recently done a podcast called Hydrogen 101 as part of its Switched On series. So from iron ore titans pivoting to cleaner energy to talk of a hydrogen revolution, that's it from this week's edition of Bloomberg Green. We'll be back next week with a deep dive into the state of electric vehicles. And you can keep the conversation going by following us on YouTube, Instagram, and Twitter @Climate. I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and this is Bloomberg Green.
The great sci-fi art of the mid-20th century teased a vision of the future with one distinct element in common: a life for humans in outer space. Whether vacationing on an exotic new planet or commuting to the moon for business, space travel seemed like it was just around the corner. Yet here we are, a half-century later, and only about 500 human beings have ever left the bounds of Earth's atmosphere. But thanks to a set of ambitious private companies betting on the promise of space tourism, that long-awaited future could be here sooner than we think. For most of the history of spaceflight, governments have been the prime force behind nearly every aspect, from planning to funding to crew selection. But as early as the 1980s, proposals for commercial space tourism began to emerge, along with innovative solutions for getting people there, such as the wild concept of sticking a 74-person passenger cabin in the cargo bay of a NASA space shuttle. Although various non-astronauts have been selected for missions over the years, true space tourism didn't happen until 2001, when an entrepreneur named Dennis Tito coughed up an estimated $20 million to hitch a ride with the Russian Federal Space Agency for a week-long vacation aboard the International Space Station. 20 years later, we're seeing a new contender in this final frontier of tourism: private companies.
It's becoming a private enterprise situation, still very high risk with a high reward, potential reward. But, government is really out of the business of flying people now, and it's really going to be companies like Elon Musk and Jeff Bezos and Richard Branson that do that heavy lifting. Commercial space tourism is usually about taking the non-astronaut, the private citizen, into an orbital or suborbital flight. So you get a short amount of microgravity experience, and you can float and take some photos. And then you come back. This was something that technology had gotten to a point where the private sector was going to make a business out of this. There are multiple companies that want to get to the place where they fly people into space.
The first of these is Blue Origin, founded in 2000 by Jeff Bezos. Using the autonomous rocket system New Shepard, a tribute to the first American in space, Blue Origin plans to launch up to 6 passengers at a time, offering a rarefied treat of 62-mile high views and a momentary experience of weightlessness. Booking officially kicked off in May 2021, with the very first seat to be auctioned off for charity. Meanwhile, Richard Branson's Virgin Galactic has also been pursuing a viable form of suborbital tourism, aiming for a launch in 2022 once Sir Richard himself has taken a flight.
I'm hoping to be able to go to space. I'd love to be able to coincide it with the moon landing and go to space. So I've got the whip on the team, and we'll see how we go.
The company claims to have lined up over 600 seat reservations so far, including Justin Bieber and Leonardo DiCaprio. Virgin has projected that the final cost of the ticket will be at least $250,000, or roughly $50,000 for each of the 5 minutes or so of weightlessness that you'll get to experience. Although costly, both companies' offerings aim to make suborbital flight a regular form of adventure travel, eventually driving down costs at scale to expand the customer base beyond the orbit of celebrities and billionaires. The third major contender is Elon Musk's SpaceX, which has set its sights even higher on orbital flights, which are
a whole nother level of complexity and energy and danger. When you go suborbital, if you're just going to go up above the von Karman line, which is 100 kilometers or about 62 miles, you only need to get up to maybe 5,000 miles an hour to get up there, and you go basically straight up and then straight back down. You don't have the reentry heating that you would see coming in from an orbital. So when you go orbital, I don't care if you're a baseball or a battleship, you've got to go 17,500 miles per hour, not just 5,000 miles an hour. The energies involved are much greater. By doing that, SpaceX has gone another level up, and that's what they're doing with the Inspiration 4.
Visit inspiration4.com for your chance to go to space.
Inspiration 4 is the first planned all-civilian mission into orbit, slated to launch in late 2021. The crew will bring their own set of diverse perspectives and backgrounds and experiences to test how a group of different people, namely people who aren't professional astronauts, could fare in space.
Until now, astronauts have had to be physically perfect, and this mission is changing that. And so I feel incredibly honored to be representing those who aren't physically perfect. At age 10, I was diagnosed with bone cancer, and I was treated at St. Jude Children's Research Hospital. And I spent a year there undergoing intense chemo and also surgery that ultimately saved my leg. I now work at St. Jude as a PA, a physician assistant, and I work with leukemia and lymphoma patients. The kids we work with are so brave, and they are very excited to watch me go to space because this is showing them that, you know, they're capable of doing this as well.
Haley, along with 3 other crew members, will spend 3 days in space, orbiting the Earth every 90 minutes before landing back off the coast of Florida.
Well, when you think about access, the first astronauts for the United States came from the test pilot side. And so women weren't allowed to be a part of that. We have somebody in their 20s, somebody in their 30s, somebody in their 40s, and somebody in their 50s. And so there can be access in all kinds of ways, whether you're talking about age, whether you're talking about gender, whether you're talking about race and ethnicity, and all of those things.
The first time, people are going up into space and not sent there by a superpower like the United States or Russia or China. Well, that's really significant. And you've got to be very thoughtful about it. The whole game plan right now is to make space really affordable and accessible for everybody, so that you can have fishing buddies going to space someday. But the first is special, and so with that, we wanted to have a crew selection process that could make space available to everyday people.
Getting to space is only the first step for space tourism. The next challenge is what to do and where to stay when you get there. Axiom Space is planning to launch the first segment of a new commercial space station in 2024. Their $2 billion project, called Ax Station, will become the first free-flying private international space station. Or, to use a more consumer-friendly term, a space hotel. Axiom isn't the only company out to make your space stay a little more comfortable. Bigelow Aerospace has been building what they call expandable habitat technology, like their B330, an inflatable pod module that expands once in orbit.
There's even one attached to the International Space Station right now they've been testing. And you take it up, and it's rather small, and then you inflate it, and it seems to be working very, very well. This is likely to be the first kind of tourist hotel that you're going to see up in space. First of all, it's easier to carry instead of this giant tin can with all of that. The inflatables are lighter. You can just blow them up, and they get a nice big size for about less than half the weight, probably.
But even as space missions become accessible to civilians,
the risks of going into space are incredibly high. And you could die 1,000 ways that we can think of and 1,000 other ways that we can't think of.
this is Michelle Hanlon. She's a space lawyer at the Mississippi School of Law, focused on protecting humans in outer space.
Now, I'm not an attorney for any of the space tourists, so I haven't been privy to their private contracts. But I can tell you that the FAA requires certain waivers to be in those contracts. So, for example, the FAA says, well, we're not going to make you make your spacecraft to a certain safety level. We are going to make you, spacecraft operator, make sure that you inform your space tourists of all of the hazards that you know of. I imagine a very long waiver, all the ways you can die in space. And you have to understand that there's health risks, and you have to indemnify the US government if you are launching from the United States. So those are things that we know a space tourist has to sign and has to waive. So now let's go back and think about our space flight participants. The FAA calls space tourists space flight participants. They don't call them astronauts. Why is that important? If you're not an astronaut, there's no obligation to rescue you if something goes wrong. It's a lot of money to set up a rescue launch. If it can even be done, it's something really important to think about, and that difference as we cross this threshold from having astronauts in space to having real people like me in space.
And when we are able to make it to space reliably enough, there's still a host of other legal and ethical issues to consider before space tourism can truly take off.
There are so many gaps in space law that we are going to have to put in a lot of sort of basement ideas. And so, for example, the Outer Space Treaty is a treaty that offers principles and guidelines for state activities, for the activities of national governments. It doesn't talk about private entities. It doesn't talk about humans in space. So now if something goes wrong, so let's think about all the times hotels on Earth are sued, right? So slip and falls. You step on something in the bathroom, you sue the hotel, and it becomes a private lawsuit. Because of the vagaries of international law, if something happens in space, well, boy, you can sue the state that launched your spacecraft, you can sue the company that brought you there, you can sue the hotel, you can sue the individual, you can sue every government related to that, because the way the Outer Space Treaty and the Outer Space Regime have set this up is that anything that happens in space first has to go through a diplomatic channel before you think about suing in a court of law. And so every single slip and fall in a space hotel is a diplomatic nightmare. And so we really need to figure that out before we start sending a lot of people there. You think about human rights in space. Here, we don't think about a human right to oxygen because it's kind of all around us and free. It's not in a space hotel. So what happens if something happens and the oxygen depletes? Who gets the oxygen first? And then, of course, let's not even think about the labor. How do you treat your labor in a space hotel where that person may be there for 2 or 3 years without coming back to Earth? So a lot of things to think about.
Space habitats are more likely in the near future to focus on research missions and be a home for experiments that can't happen as easily back on Earth.
Space hotels, I think they garner a lot of headlines and a lot of news, but at the same time, that's not the first thing that you're going to see happen. They don't offer the compelling business case, I think, that you'll see from a place that wants to manufacture pharmaceuticals or a new type of crystal or some type of filament or fiber optic cables and other things that you can do in microgravity. The things that are actually, a high value finished good, when you get that back to Earth and you sell it for a very, very huge profit margin, that's what's likely to happen in space, as opposed to having a real estate platform that you sell to a tourist. A space hotel is really interesting, and it will probably happen, but it's not likely to be at the forefront of space commerce.
Even if space hotels are right around the corner, don't get too excited about booking a trip in one.
It's not a cheap ticket to ride to space, and it's going to be, millionaires and billionaires and that sort. But at the same time, the point was made that in the early days of airline trips, that was also a completely unaffordable ticket for most people. Those people who flew were people of means, and over time it becomes affordable to the masses. And I think that's the goal for all the entrepreneurs in space as well, to get those costs down to a point where it's not $10 million or $5 million or $300,000 ride into suborbital space. When it becomes more like buying a first-class ticket to go to Europe from the United States. So that's the goal, and the question is, can we get to that point?
Given the immense operating costs of getting to space, it may be years, if ever, until space tourism becomes a profitable venture for any of these companies. Virgin Galactic, the only publicly traded company of the three, has had a particularly rocky year, initially riding on the momentum of a SPAC deal, but more recently beset by launch delays and major funders, including Branson himself, selling large quantities of their stock in the company.
Space is really, really, really hard, and it's an absolute cliche, but it's one that happens to be very true. It's just really hard to do. That's also the reason that you've seen the delays that, Virgin had talked about flying years and years ago. And it became such a crazy point that Richard Branson actually stopped talking about it when he was asked, because it was never going to be when he predicted. But it's not insurmountable. And, investors have stepped up because this is something that is doable.
Despite the astronomical dangers and costs of getting to space, it may ultimately follow the course of other once fanciful modes of travel.
Wright brothers having, what was by modern standards a very unimpressive first flight, at Kitty Hawk. I mean, you had less than 20 years later, you had your first airborne ambulances being used to save lives. Fundamentally, the world is a more interesting place when people can go and dance among the stars and such.
The lure of space is innate. It's in our DNA. It's that exploration bug. We are an exploratory species, and we want to go out there and see what's out there.
That vision that I had in 1969 of seeing normal human beings travel into space, it's finally beginning to happen. When you get a bunch of people up there and they can all see it for themselves, that'll create even yet another revolution in how we treat our planet and the way we think about it.
So while 2001 came and went without quite looking like Stanley Kubrick's ultimate space fantasy, 2021 might finally be the year we're catching up.
If you visit California, you might be inclined to go to Disneyland, or jump in your convertible and take Highway 1 up the coast, or maybe make a pilgrimage to Yosemite. All very fine choices. But if you're the kind of person who revels in our planet's extremes, then it's Route 395 that you're after. This one glorious road will carry you from Death Valley's desert floor to sky-high views of Mount Whitney. You can see the 5,000-year-old bristlecone pines, the oldest living organisms. or the bizarre Tufa Towers of Mono Lake. And true to California's boom and bust spirit, you can saunter around the ghost town of Bodie. What a novel experience to find an empty American city where all the businesses are shut down. To do 395 upright, it helps to have a guide. And mine is a man named Jan. And his crew, Aaron,
Let's tidy up first.
and Lemmy, the hardest partying dog of all time. Jan agreed to show me some of what 395 has to offer, but only if we agreed not to disclose any locations.
My name's Jan Swirstra. I'm an industrial designer out of LA, and I spend a lot of time camping and a lot of time in the Eastern Sierra. It's a place I love, and sometimes I'm known as 395 North because my Instagram account, and I don't like to be known as that, but I'm trying to use it to set a good example and do more with it than just social media.
Where did we end up camping? We got here late last night. I wasn't even sure where we are.
This is BLM land, right on the outskirts of National Forest, and it's one of my favorite places in the world. Basically, everything outdoors wrapped into one.
Yeah. Good thing about California, man.
Oh, man. We have so much national forest and public land that you can literally just cruise out and find a place to camp. It's ours.
What I wish was mine is Jan's sweet truck.
It's a 2019 Ford Ranger. Has about 200 watts of solar in it and a fridge, and has everything that an RV has except for a toilet, but just on a smaller, simple scale.
And you drive us around day to day in LA.
Yep.
And then just roll out when you want.
It's my daily driver. Handles great. And then when I'm done with work, I can just bail and go camping. So the camper basically has only what I need. Think of it as backpacking with a car.
Yeah.
The fridge has a couple compartments. This is just a kitchen box, stove, utensils, and a bunch of stuff. This one has just dry food. Then when you get inside, there's a bed. The bed flips up, so you've got tons of room in here. This awning is phenomenal. If you want to pull that over.
That's cool.
Let me just pop that up.
Sorted.
So, home on wheels.
Yeah.
This is my vacation house.
Dude, it's so nice, man. Even with his nomad lifestyle, Jan faces the same big question as the rest of us. Do the internet and smartphones have to ruin everything? When you find the super special, beautiful spots, is that you busting out a map and like looking where it might be cool to go, or is it word of mouth and just getting to know people, the locals? And
if I see a dirt road, I just want to go down it. So a lot of it's just aimless rambling. It's a desire to just see something. Check that out. For some reason, it's more fulfilling than getting a recommendation from somebody. Or there's tons of apps and websites now, road trip apps, camping apps. They've proliferated. The knowledge is accessible on the internet, right? I used to fight the geotags, and I would get really pissed off. I'd be like, why are you posting this place? It's gonna blow up, it's gonna get trashed. Now I've realized that you can't fight it. The internet has just shrunk the world. So we're not gonna stop it. We're not gonna stop people from going there. So I'm a lot more focused in conversation now with trying to set a good example. When you go, pick up your trash. When you're pooping out in the wilderness, don't leave your toilet paper on the top. You know, make sure you follow, good steps for leaving no trace.
as a thank you for this quick guide to pooping etiquette, we made Jan, Heron, and Lemmy some tacos. And we all took in the night sky and knocked back a couple of drinks. Take that, Apocalypse. The thing about good times and serenity in 2020 is that they're fleeting at best. After we split up from Jan and continued on our way, smoke started to envelop us. The plus side was that our RV no longer smelled like feet. The downside was breathing. My man David here suggested that we try and outflank the smoke by cutting through Yosemite. Without a reservation, we had to talk our way in.
Yes, no stopping, no getting out, and yeah, no problem. We just wanted to get through.
It was a beautiful choice.
Glad we got out of the smoke.
Whoa, okay. But not quite as effective as we had hoped. Fast forward 4 hours or so, and we had managed to trade the smoky majesty of Yosemite for the smoky, look at it, strip malls of the Central Valley.
We have made it sort of out of the smoke, all the way across Yosemite National Park and here to the gorgeous Central Valley of California. We're off to see a kind of surprising tech startup that is making some pretty strange machines to serve all the growers out in this region. And we're here in this near Fresno. This is California farm country, right?
We're just south of Fresno, a town called Kingsburg. So we're right in the Central Valley of California. Very, very large farming valley here. It's kind of considered the breadbasket of the world.
The Central Valley stretches out over about 20,000 square miles, and the farmers here produce about 1/4 of the food that Americans eat, including a whole lot of fruits and nuts.
Tell me a little bit of the background of Gus. I know some of this is like a family business. The roots of this go back a ways. Tell me kind of like how we got to what's essentially like a startup, I guess.
Yeah, definitely. So the founder of our company is Dave Crinklaw, and he started the business back in 1982. He started with is basically with his dad was commercial spraying of trees and vineyards. Got to the point where our biggest challenge was labor, just the shortage of it, really. He was forced into innovating, and he had this idea for quite some time about doing a driverless sprayer, and it finally got to the point where he said, you know what, I either got to get out of this business or I'm going to innovate.
Organic or not, crops need to be sprayed, and this process has to take place a few times a year. This means hiring a lot of people to work long hours under serious pressure. And so, just like the tech bros to the north, Gus decided to solve all of its problems with robots.
On this like labor point, you guys have set this up where you can have somebody in a truck and that one person can monitor, I think like 8 of these.
In order to operate Gus, you have one guy or girl that sits in a pickup and they monitor from a laptop computer. So that person is basically just watching all the vehicles on the screen. They can monitor up to 8 of them at a time while they're out there spraying in the orchard. And so that user interface really provides them with all the information they need to make sure that the machines are safe and that they're doing the correct job. So it tells them what speed they're driving, the engine RPM, the amount of gallonage per acre that they're applying at any given time. So if any one of the machines has an issue, it's going to send an alert to that laptop.
Much like a self-driving car, these beasts use GPS, LiDAR, and cameras to see and navigate the world around them. They also rely on pre-built maps of the orchards for extra guidance. Gus builds the machines right here, and then takes them out for robot training on this orchard next door. It's here that the company learns if the machines will behave and do as their software and human masters command.
So this is kind of like this is a test orchard where you guys put it through the paces and work on the technology?
Yeah, so this is our test orchard right here. It's right by our building, as you can see in the background. So every new machine, as it comes off the assembly line, it's put through a commissioning test right here. We test all the sensors on the machine, autonomous computer, all the safety systems, make sure it's doing what it's doing prior to when it's delivered to a customer.
So what's it doing now?
So right now he's doing a test spray. So he's just turning the water on to make sure that the system comes up to pressure, spraying water out of the nozzles just to make sure it's all functioning properly.
Okay. It's got like a crazy turbine at the back, or?
Yeah, so it's basically just a big fan.
Okay.
And that fan's driven off of the Cummins diesel motor, and it just basically creates a big airflow.
Gus is already selling these vehicles to brave modern farmers. And people the world over have taken notice of its machines.
And have you just sold them in the Central Valley, or like throughout the U.S., or even overseas, or where are they going?
Yeah, so right now the majority of our machines are here in California in the Central Valley. However, we do have machines and customers in Florida, in the citrus industry over there, as well as Australia.
And I think you started selling them in like December of 2019.
Yeah,
right?
So we started taking orders early last year for the sprayers, and the first deliveries we made were in December of 2019.
Okay, so. And how much do they cost each?
So our retail price on these machines is $285,000.
So it's not a small investment, but I'm sure the regular sprayers aren't cheap.
Yeah,
either.
I mean, we're honestly not too far away from conventional equipment on our price, and the main thing is that the return on investment is very, very quick due to all the labor savings and the increased efficiency. I mean, these machines, they just thrive. But basically what we're doing, besides this machine, this is our first machine. We call it Orchard Gus, mainly designed for your nut trees, as well as citrus and fruit. In the future, we're working on a few other projects. We're going to do more machines. One of them is actually a vineyard sprayer. So vineyards are much tighter spacing, so the machine has to be physically smaller. And then we've got our eyes on doing a lot of other innovating.
That right there, friends, is a Central Valley farmer putting his whole fruit basket on the table. Gary's TED Talk can't be far off. And with that, it was time to get back in the RV and to confront what happens when three men are bested by their own failings and the forces of entropy. Next on Hello World, we cruise into the Mojave Desert in search of a lunar lander.
We have instruments that we are going to deliver to the South Pole of the Moon in December of 2022. Instruments that are trying to scan the surface of the moon.
And hang with a test pilot who walked away from this.
Meet Betty. She lives by herself, but for the last few months, she hasn't been alone.
LQ, tell me a joke.
Did you hear about the claustrophobic astronaut?
No.
Apparently, he just needed a little space.
Most technology isn't made for 93-year-olds. But this woman is making sure that this particular robot is.
LQ, who are you?
She's researching the way we interact with machines. And if she has her way, robots will soon be a trusty companion for all of us.
My name is LQ. How can I help you?
As technology replaces old jobs, it's also creating new ones. I'm Aki Ito, and I'm here to show you the jobs of the future.
My name is Danielle Ishak, and I am a human-robot interaction researcher. It's really hard to intuitively design a robot meant for a consumer audience. You have to make sure that it's a robot that people want, people know how to use, and people value.
Danielle works for an Israeli startup called Intuition Robotics. Its U.S. office is here in downtown San Francisco.
Hello?
Hey Danielle, it's Aki.
Come on in.
The company is funded by a couple big names like Samsung and Toyota. Full disclosure, Bloomberg's venture capital arm is an investor too.
This is LEQ.
Can I take her out for a spin?
Please.
LEQ, tell me what you can do.
I am a proactive social robot designed for older adults. I can connect you to your family and friends, and even play music.
These features might remind you of the Amazon Echo, but you'd be missing the point if you compared her to a smart speaker. She's not meant to just be useful. She's meant to be a companion.
Why don't you take a break and have a drink?
And that's why she has a head that can nod and make other subtle gestures you might expect from a pet.
Through our research with older adults, we're finding that almost on a daily basis, we see that somebody tells her that they love her.
Really?
Or that they like her.
Like,
or that they miss
literally,
her.
I love you?
Mm-hmm. They'll also tell her, I'm depressed, or I'm lonely. They'll open up to her in a way that they might not necessarily open up to a human because they don't feel like they'll be judged.
LEQ isn't on sale yet. But a prototype is already in the homes of about a dozen early testers who live in the Bay Area.
LEQ, tell me what the weather is today.
Danielle's job is to figure out what's working and what's not.
Sorry, please rephrase your request.
And she does that by visiting each of her testers twice a month.
How important are these visits to your job? They're critical. We're building a product for people who we are not. I'm not a senior, and how could you know how to design for somebody if you don't do research? Because otherwise, you would just be designing in the dark.
Jobs like Danielle's are just starting to emerge. Until recently, robots were mostly in factories, separated from humans. But now, they're finally getting cheap enough, small enough, and smart enough to be in our homes. This has created a whole new challenge of designing robots that people will actually want to interact with. And that's where Danielle comes in. Her research has helped shape every little facet of LEQ, from the way LEQ moves to the way she talks.
It's a very special job, and it can be really hard, and it can be really frustrating, but at the end of the day, it's incredibly rewarding. And I think the most rewarding part about it is when I see the joy on the users' faces, like that they saw their feedback turned into something real.
Today, we've driven east of San Francisco to go see one of Danielle's research participants.
LEQ, tell me something interesting.
Did you know that Ronald Reagan was a lifeguard in high school and saved 77 people's lives?
Now, see, this is where a conversation is. She should open up and I should say, no, I did not know that. I expect her to be able to continue a conversation for at least a couple of comments.
Yeah. And why is that?
Why?
Yeah.
Because that's companionship.
When Betty was around Danielle's age, she was working with some of history's very first computers.
When I was finishing up my master's degree, I was working at Harvard in the computer lab when they were building Mark IV. a large room-sized computer. But now, this artificial intelligence stuff is amazing. LQ?
Yes,
Schedule a doctor's appointment.
no problem. I'm working on it.
When Danielle brought along the idea of working with robotics for the elderly, I said, are you kidding me? Will older people connect to a robot? And she said, I don't know, let's research and find out.
Danielle grew up here in this suburb of Atlanta. Her parents spent much of their childhoods in Israel and met in the US.
We as immigrants, we understood that we might need to work a little harder. In fact, I feel that rather than taken away from Danielle, it gave her so much more, because she understood the fact that you need to run after your dreams and work really hard, no matter what the challenges are.
School didn't come easily for Danielle.
I have dyslexia, and that very much affected my self-esteem academically.
The principal of the school did not recommend her to take advanced classes. She fought for it, and she got into it, and she did very well with them, too.
Danielle's first job out of grad school was at X, the secretive research facility founded by Google. It's known for dreaming up all kinds of wacky, far-flung ideas.
Can you tell us about the moonshots you worked on?
No, I can't tell you too much about the projects that I worked on. I can't say that I was working on robotics.
She loved the job, but wanted to work on something that would reach real consumers sooner. So she left X after a year and joined Intuition Robotics. She's been working in the field for 4 years now, and it took her a while to find her footing in a male-dominated industry.
I've gone to different meetups where there'll be like a circle of men with their like zip-up jacket with their like company logo on it and a beer in their hand. And I'll come in with lipstick and nobody wants to talk to me. This is my closet.
So at first she did her best to fit in, wearing a pair of glasses she didn't need and toning down her style.
So what's the kind of thing you used to wear to a conference?
Stuff like this, blousey things that make you look like you're 40.
But that got old after a while.
And what's the kind of thing you wear now?
Now it's like I just enjoy being kind of expressive and playful in what I wear.
Before we wrap up for the day, Danielle has one more LEQ tester to visit. Joseph is 97. And he's had the robot in his home for 8 months.
How are you?
I'm fine. How are you?
Good. How has Miss LEQ been?
She always tells me to take a drink of water at least 4 times a day.
So, we added a whole bunch of new facts to LEQ.
Did you know that a cup of chopped red bell pepper contains more vitamin C than an orange?
Okay. What did you think of that?
Certainly the print was, I could see that quite clearly.
What about this?
I can see that. LEQ, play music.
No problem. It will begin shortly.
By 2050, almost 500 million people are going to be 80 or older. And if current trends continue, more and more are going to be like Joseph and Betty, living alone.
LEQ, stop.
Today, both of them are doing okay. But some of Danielle's other participants have been struggling.
testers are pretty advanced in the stages of depression through loneliness and isolation. And at times, I know that LEQ is cheering them up in their day, but I know that it's only part of the way. No source of artificial intelligence, robots will ever be able to replace humans and human companionship or human care.
The key to Danielle's work is to embrace that very limitation of machines.
Robots should help humans do what they love, help humans interact with more humans, help humans in general. Not pull humans away from humans, not take humans' jobs and leave humans without purpose.
Whether it's in our workplaces or in our homes, robots are soon going to be everywhere. And it's up to Danielle to make sure this robot-filled future leaves us just a little better off.
So don't be afraid. And if you are afraid, come and join us, because I promise it's a friendly place.
Times are tough. Jobs are scarce. It's risky to be outside and around others. It seems like there's very few ways to make extra money during a pandemic. So I guess I'll just hunker down and binge social media until this all blows over. Wait, don't these people make money? How do these people make money? Streamers, YouTubers, Twitch stars. How do they make money? Is it a lot? Is it a lot of work? I know, I gotta ask somebody in the biz, and I got just the guy. Austin John Plays.
This is your full-time job now, right?
As of November of last year, yes. This was always just kind of like a side thing. Like, any money that I made from doing my videos and whatever else, I never touched that because I didn't really think of that as being like real money. And then it started coming in more and more. And then it was like I hit my first day that I broke $1,000 and I was like, this is actually going to be money.
How did the YouTube channel come to be?
When the game Pokemon Sun and Moon came out for the 3DS, there was like things that I learned about the game, and then I wanted to just share that information with people. And at the time, I didn't have any way to capture a screen or anything, so I found like generic footage and I kind of put it all together with so much editing. And that video got 6 views. And then 2 days later, I made another one, and that one got 12 views. And then I just started pumping out more and more content, and people were like, this guy knows what he's talking about. It really just started building on top of itself, and then it was like, my channel really focuses on tips and tricks. So I play a straight 18 hours, and I'll finish the game or get to about the 40-hour mark, and then I'll make my first video. While I'm going through, I have a giant notepad and just scribbles everywhere, and I make these notes of like the things that stumped me, so I know the things that may stump other people.
What do you need to think about if you're building your YouTube channel?
1, you need to do something that you're passionate about. Not that you like, not that you think you're gonna make money on, something you're passionate about. The other thing is something that other people are passionate about. It holds a special place to them. And third is, it needs to be something that people are gonna seek out information on. In order to enter into the marketplace, you either need to be better than everyone else, you either need to be faster than everyone else, or you need to be more accessible than everyone else. And you can't be more accessible because it's already on the platform. Granted, if you understand how the algorithm works, which is very similar to Google Analytics, then yeah, you can have a little bit of a head start. But if you're not doing it faster, and if you're not doing it better than everyone else, then why should anyone watch your channel? So my income as a YouTuber kind of breaks down to 3 different ways. 1, which is the bulk of it, which is ad revenue. whenever you go and you watch a video and then there's an ad and then you wait 5 seconds and you hit the bottom right corner and then you go on to the next video, or a non-skippable ad, or the video starts immediately, you get the little banner ad at the bottom, or if you scroll down from the video, the first thing that shows there is an ad. Those are the 4 different types of ads that can appear on every single YouTube video. And all of them pay a certain amount. It varies on lots of things, like the country of the person who posted, the country of the person who watches it, the time of year, where you are in the quarter, if there's anything going on with a reduction in ad revenue. Like, great example, COVID-19, companies weren't spending as much on advertising. So because of that, CPM went down. CPM stands for click per thousand. I'm using the Roman numeral for 1,000. And that means that for every 1,000 views, you get a certain amount of money. Now, on low ads, when I first started off, my CPM was 30 cents. So every 1,000 views, I made 30 cents. But then once I signed with an MCN and I started making more quality content and more engaging content, some of my better videos and certain times of the year, I can see CPMs as high as $12 to $14. And there's a big fluctuation between, if I post a video when there's no ads being spent, like January and February, that's the reason a lot of your favorite YouTubers and also TV shows don't post new videos in that time of year, because ad rates are down. Why are they going to make content then? Instead, you're recording and you're bulking up for when ad revenue is higher. The second way that a YouTuber makes income is support, crowdfunding, things like that. When I first started off, Patreon was really the only option, but then they started rolling out supporters and members for YouTube channels. So whenever I have a live stream, you can click a button and then you can become a member, and then you get special icons next to your name. I believe they're called badges. Or on any video, you can hit the join button, and that helps support the channel. And then the third aspect of that would be merch. And for me, my merch has been somewhat basic. In fact, I'm wearing one of my t-shirts from last year right now. You have to endure the times that your first video gets 6 views, that you posted on Reddit and they say, shut up, and then an auto mod bans you. You have to go through that, because until you go through that and you discover why you're doing it, you're not doing it for other people, you're doing it for yourself. If you're not loving what you do, then it's not worth it.
Huh. So make a channel about something that I'm passionate about. Oh, sweet. I guess I can make the channel about that. Now, how do I grow an audience? How do I get popular?
It's all about diversification, right? You have to have a massive Twitter following. You have to have a massive Instagram following. You have to have a massive YouTube following. Of course, you have to be on Twitch, which is the key platform. But basically, any way you can get in front of your audience, you can engage with your audience, is going to drive those clicks, which ultimately drives the advertiser revenue that you get back from all of these platforms.
It's me and Dan playing video games and talking in a funny manner over them.
They're not just people who are good at games, they're actually people who are good at online engagement, online entertainment, first and foremost.
You have the right to remain stylish. Anything you wear can and will be used against you in the court of fashion.
The streamer is either very, very talented at the game. The best player in the game is generally going to draw a crowd because people like watching people who are very good. On the other hand, they're either very, very good or funny, charismatic, whatever it is on that side.
Oh, no.
You know, it becomes more of a show where they talk about other things outside of the gaming world, and gaming becomes really just a backdrop and an excuse to engage with that audience.
There were those weird, like, Ronald McDonald, like, straight to VHS movies. You remember those?
I'm personable, I'm chatty. I would kind of, when boring things were happening in the game, I would ramble on about, movies I'd watched or books I'd read and, or conversations I'd had and stuff like that. And so I think being personable was a big part of that.
It's not just getting on and playing games. It's getting on and being an entertainer. You are putting on a show.
All right, now let me go ahead and grab the samurai sword that every gym has. Okay, he's dead.
To have a larger audience and to have that audience, I think, stay with you, you have to bring something extra. You know, you have to find your niche. You have to find what works and what connects with the audience and what makes them laugh and what makes them keep coming back.
And you gotta.
I think the real most important thing is to just get used to being on camera. Like in any sort of performance thing, is get used to talking on camera. You know, my first few videos were terrible, but because I sat down and did it for 6 to 8 hours a day, I just got used to talking and I got over that uncomfortable hump.
If you go into Twitch purely with the expectation that you're going to make money, make a job out of it, have all this growth, and it's going to be great, you're probably going to burn out prior to getting to that point because there's very little payoff for a long time, right? Like multiple years generally before you really start to see a payoff. And so, you know, those first few times you're streaming, nobody is there. One person shows up every 30 minutes, says hi, maybe, and leaves, right? Like, it's very discouraging, I think, for a lot of people. And so you have to be there just loving it. You have to love talking to yourself when nobody is around. You have to love just the game that you're playing, all of that stuff, because it takes a while. And I think a majority of people burn out prior to getting to the like profitable point of it.
And there you have it. My very own YouTube, Twitch, Discord, and streaming channels all ready to go live. It's a veritable social media ecosystem just on the verge of thriving. So, don't forget to smash like and subscribe, and visit my Patreon for perks. Also, go to my merch page. And one last thing, stay cool, my friends.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
And a very good afternoon, everybody. Live from the Bloomberg Interactive Brokers studio, streaming on YouTube and Bloomberg Originals. It is Thursday, May 4th, 2023. I'm back here at Bloomberg headquarters in New York City. Tim, you know, is on leave, but great to have back with us Bloomberg Quick Take correspondent Maddie Mills. And, you know, Madison, we're having another day where we've seen stocks lower, but it's really, once again, about regional banks.
Yeah, it's that broad-based sell-off when it comes to the financial space, and we're going to talk about the latest carnage from PacWest to some of those other banks, including the $54 billion wipeout, thanks to those specific busted banks as well.
Yeah, it's really weighing on the overall market caps. Plus, we've got a batch of U.S. economic data points we got to earlier today. We're going to talk about that, how that kind of fits in with the Fed commentary that we got yesterday, and ahead, of course, the monthly jobs report tomorrow. Big earnings day. Apple. I mean, about 4:30 Wall Street time. We're going to be breaking them down. But let's not forget Lyft also reports.
Right. Apple, and then a little Lyft mention ahead of that as well. And Carol, such a cool story. So glad we're including this. The billionaire space race. Obviously, it's on, but a little bit of competition for Elon in the form of a dishwasher engineer. So that is going to be a great story to talk about.
My dad was, you know, an engineer of so much, and like you can't rule out like those engineers.
Absolutely not.
And there's a lot going on in the private space when it comes to space specifically. We're also going to tell you about the media company trying to build a right-wing Disney. They've been out there, well-known in podcasts, but they are looking to really spread their wings when it comes to content distribution.
And then we're going to wrap our program with Chattanooga, Tennessee's Mayor Tim Kelly. He is joining us again to talk infrastructure, innovation, politics, and how he's handling the work-from-home movement for his city, which is a really cool look at kind of those low-key economic indicators we love to talk about, Carol.
He's an independent, too. I'm curious why and why he continues to be one, and I'm curious about his political aspirations as well. So I love getting the view on the ground when it comes to our country's mayors. So lots to come in the next 3 hours, folks. But right now we do want to do broad macro in terms of the markets and also the economic backdrop. As we mentioned, we did get a bunch of data points earlier today, a read on productivity, also labor, but we also have a spike in the VIX, and we've got a market trade where we're seeing some broad-based selling. So let's start with the markets. Abigail Doolittle is here. She is markets reporter at Bloomberg News in our Interactive Brokers studio. Abigail, good to have you here. Talk to us a little bit about the trade and what we're seeing.
Well, it looks a little bearish. We have the S&P 500 down about 0.7%, the NASDAQ down a little bit less, so we're seeing a little bit of that quote-unquote safety trade for big tech. But the point I would make about markets, we now have stocks down 4 days in a row, the longest losing streak since February 22nd for the S&P 500, the worst slide since the middle of March. So investors are nervous. Now, it's easy to say it has to do with the Fed, and it probably does have to do with the Fed, but we do, of course, have Apple earnings after the bell, as you guys were just talking about. That's going to be a big one. It seems as though investors are waiting for something else. Maybe jobs tomorrow. Maybe that could be, you're talking about eco data tomorrow. We, of course, have that non-farm payrolls report. It looks like there's another Goldilocks expectation, but maybe if it comes in way high or way low, it's going to set markets spinning a little bit.
Can I ask you about the regional banks specifically
Yes.
in terms of market weighting and the impact that they are having on the overall trade? We know financials are down in a big way, but I always think about perspective, right, in terms of market weightings and how much it really sways it specifically, or also how it sways it in terms of sentiment?
That's such a great question. So as you're asking this question, I'm furiously typing in some information on the Bloomberg to see exactly how much percentage, if any. So PacWest is not a part of the S&P 500. Western Alliance, bear with me very quickly.
No, that's fine.
Is
She's working in real time. I love this.
Is also not a part of the S&P 500. So you have these two regional banks, the one trading now less than $4. It had been a $64 stock back at its peak in 2007.
There's size and scope perspective.
Yeah, I mean, it's just incredible. Western Alliance down 35% to PacWest 42%. And clearly the idea, crisis and confidence. So this is a clear idea of sentiment weighing. Now, is this why the S&P 500 is down? Truthfully, I don't really think that it is. I mean, I feel like it's its own little pocket of mess, but pretty well contained. And you have somebody like Jamie Dimon earlier this week saying that he thinks, I mean, he had been calling it banking crisis, but now saying that it's over. I mean, it always seemed kind of like a turmoil to me. But the sentiment, yeah, it's definitely could be bleeding in today for sure.
So, Mike, come on in here. Talk to us about the eco data that we got today that markets potentially are ingesting as negative. What was the most important highlight to you, and what does it show more broadly?
Out here, but the data that we got today isn't all that much important in the sense that we did see jobless claims rise by 10,000, but they'd fallen by 12,000 last week. So it really kind of leaves us where we were before, without a clear sign that it necessarily means anything about a loosening labor market. We also got productivity numbers and unit labor costs that show that we did not do very well in the first quarter. Unit labor costs were up over 6%, suggests that there was wage pressure on employers in the first quarter. The question is, what point in the first quarter when you get quarterly numbers like that, as we saw with the GDP numbers, consumer spending very strong in January. By March, it had petered out. If that's the same story, then we might see a better inflation data coming up. If not, then the Fed has a problem. So it wasn't the most important day today, but tomorrow, I can promise you, you will be interested in what we see.
Well, hang on. Before we get to that, I want to go back to wage inflation, because one of the things that kind of stuck out for me at the press conference yesterday, Mike, with Jay Powell, first of all, your question, but we'll get to that in a moment, was also how he said when he thinks about inflation, wage pressures aren't necessarily the thing that they are focusing on, or that that's a big component of it, that it's other things. And I thought that was kind of interesting because I feel like a lot of the narrative, a lot of the conversations is around the wage pressures that we have specifically. But he seemed to kind of say, that's not it, folks.
Well, it's an interesting debate in economics and at the Fed, and it seems like a bit of a walk back for Jay Powell. The argument being that the labor markets are tight, so companies have to pay up more to get workers, and therefore they raise prices on their goods in order to make up the additional cost. There are a number of economists who point out that it's not a wage price spiral in the traditional sense where workers then look at those higher prices and demand higher wages to make up for the higher prices, and you keep going. In this case, seems to have been a kind of a one-off situation, and the economists who think that you shouldn't be looking as hard at wages say, look harder at other factors for raising prices.
So, Abigail, come back in. We're, coming to, I feel like, the end of earnings, at least the bulk of it. But in terms of margins, which are impacted by wage costs and other cost pressures, what did we see this time around?
I feel as though we had a lot of companies that did a good job of passing along higher prices to consumers so that margins weren't impacted horribly, at least for the most part. That's to my memory. But the question is, will that stop at some point? Or at some point, consumers going to say, no, I'm not paying for this, especially if it's a nice to have as opposed to a need to have. So that's going to be another issue, on the horizon to think about for sure.
Mike, going to you on this, as we do get kind of to the end of our earnings season, it continues to feel like a pick your poison when it comes to the data. You can kind of find the data that tells you whether or not we've gone as far as we need to go when it comes to being sufficiently restrictive here. How do the voting members suss out what is sufficiently restrictive given all of the data out there? What would you want us to know about that?
Well, it's very difficult for them, as it is for everybody, to figure out exactly what's going on in the economy now, because as you say, there's one good news piece for every bad news piece. But basically what they are doing is taking a look at the Fed funds rate now, which is in a range of 5 to 5.25%, and subtracting from that break-evens for 2 years hence or 10 years hence, depending on how you want to look at it, and seeing what you get as a real rate. And the real rate is positive now, and somewhat significantly so. And so they feel that they're finally in restrictive territory. Obviously, if inflation goes up, then the real rate goes down. So they will have some sort of measure to see what happens with inflation going forward. But that's their basic conception of restrictive.
Well, Abigail, come on in on, there was a story, and I think it was a red sticky about what Fed swaps are showing in terms of rate cuts, which we'll get to. Mike, your question, first of all, to Jay Powell yesterday, again, we think it feels like it stumped him, that it impacted the market trade about rate cuts. He seemed to be like, yeah, not going to happen.
I'm stunned. I mean, I honestly am stunned, but I have also many times with you guys talked about how this worked, that these traders, these swap, traders and bond traders, that they've just been wrong. I mean, at beginning of this year, they were talking about, I think, less cuts and then increased cuts, and then they took them back, and now we have cuts again. And here we have, I feel like, maybe Mike disagrees with me, but I feel like the Fed has been pretty consistent in terms of saying, we're tightening, we're hiking. They've made nuances in terms of saying instead of huge hikes all at once, we're going to go slower, but we are going to go higher. We're going to stay there. There's persistent inflation. We're willing to sacrifice the economy. Yesterday, no cuts, and here we have, I think, if I'm reading this right, by July, a better chance than not that there's going to be a full hike in by then, and I don't get that personally.
I would never disagree with Abigail.
Agreed.
The Fed has been very consistent in what it has been messaging. And when I saw the results on the WIRP screen yesterday after the news conference, I was amused. This morning when I saw that red headline, I was somewhat alarmed. And I started poking around and talked to some people in the markets about it. And what it seems to be is tail risk hedging, the idea that the government could fail to come up with A, an answer for the bank problem, and B, an answer for the debt limit problem, and the two might come together in June, and at that point, you end up having a debt ceiling problem that takes down a lot of banks, and the Fed is being forced to cut. But it's really hedging. It's apparently not an extremely deep market, so it doesn't take much to move that market, and it's not really a massive bet on the Fed cutting rates. They're not going to, unless we have some sort of event like that. They're not going to be cutting rates in July or August or September. It would be well into the end of the year if they started seeing bad data go forward.
So you're going on Jay Powell's word, right?
Jay Powell and the other 17 members of the Open Market Committee, they're all pretty much agreed that they're not planning on cutting rates anytime soon.
So I wonder then, Mike, were you surprised by the kind of answer tenor that he gave you yesterday, or did you sort of expect the stumping to happen that occurred?
I was a little surprised, although I think part of it was he didn't quite hear me, but I think that he didn't handle it well in this sense that he equivocated, as he has in the past about this, in saying that, well, Wall Street has one view and we have another, and if our view is right, we won't be cutting rates, and we don't think there's any reason to cut rates. But if we're wrong, then we could cut rates. And that, it just tiny little crack there, but investors slithered through it and decided that maybe it's worth putting on a little bit of a hedge, put some insurance out there just in case.
It's amazing nobody asked it sooner. It was just spot on. Mike, very quickly, jobs tomorrow. What should we look out for?
Well, you want to see the numbers start to go down in terms of job creation. We're still more than double what we need to absorb all the new entrants to the labor force. And the Fed would like to see unemployment rise a little bit, but not too much, and wage growth slow down some. So those are the top three things to look for tomorrow.
Abigail, 20 seconds for you. In terms of what we get tomorrow, any surprises? How fragile is the market right now? Certainly the equity or treasury side of things, that we could see some big swings again?
You know, Carol, great question. I'm actually a little bit concerned to the downside for the first time in a while, not relative to the jobs report, but to the idea that we could see stocks go down. And watching the yen, it's up for a third day in a row, and it looks like it could break out, which would suggest that there's some kind of haven bid building against the backdrop of stocks dropping for 4 days.
Gold was up today too, wasn't it?
Gold is, I'm trying to locate on my screen, yes, up 1%, and I think that's up multiple days, actually.
All right, good stuff. Guys, thank you so much. Great setup on this Thursday. Abigail Doolittle, markets reporter at Bloomberg News, our Michael McKee, international economics and policy correspondent on Zoom from Washington, D.C., or in a closet, Mike. I'm not quite sure where you were, but it looked kind of interesting. But we always appreciate their insight. All right, great setup, as we said, but we've got to switch to the regional banks, which are definitely under pressure once again, front and center, despite some calm earlier in the week after J.P. Morgan's takeover of First Republic. Western Alliance, Bancorp, PacWest, First Horizon, all of them, we're seeing renewed slide in some of those banks. So let's get to it. Once again, he's reading through his phone because the headlines come fast and furious. Bloomberg Intelligence senior analyst for U.S. regional banks, Herman Chen. He's back with us in our Bloomberg Interactive Broker studio. So help me out here. J.P. Morgan, First Republic. I was at Milken. I think we all kind of thought, all right, we're in a good place. Everything was calming down. Mm-hmm. So quickly that changed. Right. Where are we? How are you assessing this situation? How have we moved now to a bank crisis?
Yes. So on Monday, with the resolution of First Republic with J.P. Morgan's deal, it did calm fears for a bit. But if you take a step back, nothing has really changed from a holistic standpoint. We still have some fears, market fears, with respect to banks and their operating model and deposits and stability. And
is it just the higher rate environment problem?
It's a higher rate environment problem. It's the market has a playbook, right? With the failures of SVB, with the failure of Signature, and now First Republic, that shorts can press these banks and create their own reality. And there's no sort of floor with banks in this current market environment. There's no white knight that's going to come in and buy a bank that's in a distressed scenario, because they're just going to wait for the FDIC to come in to close that institution. And then any potential buyer just gets a better deal with the FDIC versus just doing a traditional bank transaction.
They know how it goes now.
Exactly.
Well, that's one of the things that I wonder is potentially the problem for First Republic and J.P. Morgan. Is there concern that that wasn't the best way to handle that deal and that solution, and until we figure out the best solution, we're worried about those other regional banks?
Yeah, I mean, it was the best solution for J.P. Morgan, so that's one thing. The FDIC has this view where you're trying to limit the potential losses to the deposit insurance fund. And that's great, but it also, when you do a deal with JP Morgan, you're making the bigger banks even bigger. So there's that perspective that I think is lost with that particular regulator. And maybe it was better for a bank like a regional like PNC to absorb, because it just would stoke better confidence within the regional banks, which is something we sorely lack.
Right, like Elizabeth Warren was saying today, that it just contributes to the too big to fail bank problem, and I wonder how that impacts feelings among taxpayers about sticking with regional banks.
Right, that's something that we're still trying to figure out and suss out at this point. But what's interesting is that if you look at the business models of the banks that failed, they are, with SVB, it was tech, it was venture capital folks. With First Republic, it's with high net worth customers. So if we go further down the list of regional banks, their business models are to bread and butter small businesses, and that could have a bigger effect on the overall economic trajectory of what's going on in the United States.
Coming back from Milken, people already talking about how banks, for a while have pulled back on lending, and you do wonder about the impact of these regionals. But when you look at the balance sheet of a Western Alliance or PacWest, PacWest down 61%, and it's, low today. Same story for Western Alliance. When you look at their balance sheets, what do you see?
The balance sheets are pretty stable. Both PacWest, from a deposit standpoint, said deposits were stable through the second quarter versus the end of the first. And Western Alliance actually confirmed guidance, which was interesting, that they had previously expected $2 billion of deposit inflow in the second quarter. And they reaffirmed that because they've seen quarter to date $1.2 billion in higher deposits. So from a fundamental standpoint, the banks are fine. It's just the market's just acting in a volatile manner that's offering a really visceral reaction.
So a case of the market forcing the hand of these banks, not a case of the bank's balance sheet forcing their hand.
Right. In a lot of ways, the market is creating its own reality for these regional banks.
So should we assume Western Alliance has no truth to a report of deal talks? PacWest, we know, we got that news late yesterday, right? That they are looking and exploring options. What are you thinking about, what's next for these guys?
Yeah, that's a good question. We need a more holistic type solution, and that has to come from Washington or the regulators. The investors.
To the great financial crisis, where they basically just said, you have no choice, we have decided you're systemically important and you're going to get an injection.
It's something similar to that, or to the fact that we're guaranteeing deposits for some certain period of time, or we're guaranteeing all non-interest-bearing deposits, which is what they did during the financial crisis. So something like that, I think, could instill some confidence in the marketplace that's sorely lacking today.
Any need to control deposit outflows as well on that front? Is there?
Yeah.
I mean, consumers going to do what they're going to do, and they're
consumers are going to do what they're going to do. They can do it with the click of a flick of their thumb and their finger on their phone. So it's hard to put the genie back in the bottle from that front, but it's something I know the regulators are deeply concerned about, and I think that will have ramifications further down the road for liquidity requirements for the regional banks.
One of our producers talking about, I think on his way into work, maybe passing a bank or being in a bank and talking about somebody pulling out a few million in an investment account in a well-known bank. So there's things going on, right, that certainly just create or further intensify some of the jitters that are going on. Is there another bank that we should have on our radar beyond these guys? Just got about 15 seconds.
Right now, we're not in a position to say, but you can just look at the performance since March 8th when SVB announced their equity sale.
And you could figure out who to keep an eye on. Herman Chan, thank you so much. We know it's been nonstop for you since all this began, but really so valuable to all of us. Senior analyst for U.S. regional banks with our Bloomberg Intelligence analyst team. He is here in our Interactive Broker studio. Lots more to come. Maddie and I coming back. This is Bloomberg.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:21 on Wall Street. We do check markets all day long here at Bloomberg. Apple will be reporting after the close of trading. We'll be hearing from Apple roughly 40 minutes from now. We've got Apple shares lower by 1.3%. Dow Jones Industrial Average down 352 points, a drop there of 1%. Yes, red on the screen, but the Dow is now negative on the year. The S&P is down 33, drop there of 0.8%. NASDAQ down 67, a drop there of 0.6%. 10-year yield 3.35%. We do have the 2-year yielding 3.75%. Spot gold up $10 the ounce to $2,049, up by about 0.5%. West Texas Intermediate crude down 0.3%, $68.38 a barrel. As for the economic backdrop, Julia Coronado is president and founder of Macro Policy Perspectives, and she was interviewed this morning on Bloomberg Surveillance.
Well, at the moment, the economy actually is doing pretty well. I mean, we're having a decent earnings season. The labor market has been just surprisingly resilient. Consumers have been surprisingly resilient. What we need to be looking at, though, is the risks ahead, the leading indicators, and that's where the banking situation comes into play.
Speaking of which, Western Alliance Bancorp is denying a report that it's exploring strategic options, including a possible sale. Western Alliance down 34%. PacWest Bancorp down by 46%. Recapping, S&P down 32, down 0.8, and that is a Bloomberg Business Flash.
Thanks, Charlie. Bloomberg Business Week is brought to you by BNY Mellon Insight. That's June 6th through 8th in Orlando. Don't miss this essential event for the financial advice community. You can visit insight.bnymellon.com for more.
All right. So, Maddie, we want to talk a little bit more about the bank sector because a great story on the Bloomberg targets one number in particular, although I would safe to say that the number is probably growing, $54 billion. That's how much stock and bond investors have lost following the collapse of 4 regional banks. Some say this is how the market is supposed to work, with some size and scope, though, and perspective of what more could come. Let's get to Bloomberg News consumer finance reporter Paige Smith. She joins us from our D.C. bureau. Paige, good to have you here with Maddie and myself. So let's start with the size and scope about the impact of those 4 regionals, both equity and bond sides of the financial markets being hit. Give us the perspective.
Yeah, hi folks. Thanks for having me. And gosh, it's kind of hard to follow Herman. He's so good and he knows so much. But I'll try to break it down as best as well as he did. But so we basically did a little math here and looked at the 4 U.S. lenders that have collapsed. So Silvergate, Signature, Silicon Valley Bank, and First Republic Bank, and looked at basically tallied up all of the losses that investors have been saddled with since February 28th, and this was calculated on May 2nd. So to put that in perspective, it's around $46.9 billion of market capitalization that's been erased since February 28th, and around $7.5 billion gone from bonds and preferred shares. So that's totals to be around $54 billion lost, just to have broken that down.
Yeah, it's an insane amount of money, obviously, Paige, and thanks for breaking that down for us. Going back to what you were just mentioning, preferred shareholders and bondholders, this does not include them, and is the bond holding space worthless now for these investors?
Well, no, just to clarify, so that is actually how much has been lost. So there is still some combined, I believe the market, the share value still is total, well, as of Tuesday was totaling around $725 million for those 4 lenders. But so not all is lost just yet, or wasn't as of Tuesday. But, you know, a lot of this really has to do with, as a great professor said, how the market functions, right? You know, a number of depositors were guaranteed and were made whole, but, you know, the stockholders and junior debt owners are sort of at the back of the line in terms of priority for being made whole here.
Right. So maybe not worthless yet, but close to it, or could be. So how, in terms of reporting out this story page and looking, we just, as you said, just had Herman on, and, the banks that we're watching today, Western Alliance and PacWest, and who knows what else might come our way. What were you hearing about maybe the future potential impact if we continue to see problems in the sector?
Gosh, I don't have a crystal ball in front of me at the moment, but all I can say is that prices are still extremely volatile. I mean, the volatility is sort of being felt in across the market right now. And I mean, like you said, PacWest and Western Alliance have looked a little roller coaster-like today, I would say.
Right. But what I want to ask you about is, you talked to somebody at Northwestern University, and they talked a little bit, right, about if only half of uninsured depositors yank their funds, around 190 banks with assets of $300 billion could be impaired. So we're talking about, again, we're just guessing here, they're guessing, but right, there is the impact that it could be a lot more.
Absolutely, and we just don't know right now, but it is, things are a little bit all over the place, we'll put it that way. The market is definitely still volatile right now, so yes, theoretically, if things sort of continue as they are, more could be lost.
And what did your sources say, Paige, about, the big question, which is it fair and okay that investors are losing a lot of money as we all experience the regional banking turmoil? What were your sources' responses about what that should look like, or any changes that should be made to hedge against that?
Well, to kind of address the last part of that question, there are a lot of changes being sort of batted around. As Herman sort of said a little bit earlier, there are talks about how FDIC insurance could change. There was a report that said perhaps it could be extended, or sort of the ideal option would be extending that to more business deposits to kind of maybe calm things down a little bit, theoretically. But we just don't really know right now. I did say, I spoke with one source who did say it could get a lot worse before it gets better, but who knows? And we just aren't really sure right now.
Paige, what did Mike Mayo say to you? And this is somebody that we have leaned on. We leaned on certainly during the great financial crisis. This is someone who has followed the bank sector, the big banks, in a big way. Was he thinking that there's more pain to come? I'm curious kind of what his take was on all of this.
Yeah, Mike Mayo essentially said that that he says that there are no more banks that are going to fail right now in the S&P 500 at least. But again, I would like to check in with Mike today, perhaps. Again, this report was published early yesterday morning. So a lot has changed. Everything is still sort of in flux. The market is still a little bit all over the place. I think that we just have to keep asking folks and keep making calls and checking in.
Well, and as you said, you did report this story out yesterday. You do have a story on the Bloomberg, though, that hit early this morning. And the headline, this is for Bloomberg Business Week, in fact, regional bank woes didn't end with the First Republic rescue. And you remind us that banks run on confidence, right? If we all start to feel a little nervous about where our deposits are, we're probably going to yank them.
Absolutely, and I think that is really something that remains to be seen. It's a question, and as Herman said before, there are, if we look at the balance sheet of PacWest and Western, at least PacWest, there was sort of, yes, they're in talks of determining what the best next step might be, but there were, we checked in on these banks during earnings most recently, and there weren't extremely red flags being raised, or at least that was my interpretation of things. And we'll just have to kind of see how those deposit levels fare over the next days or weeks or however long this continues.
I know.
Right.
You sound exhausted, because we're all exhausted.
Right.
Just when we think it's over,
sorry.
right? No. I don't mean it as a criticism. I just mean it's a
course.
reality. It's like how we felt reporting out the great financial crisis. You'd get some moments of calm, and then it just picked up so much momentum. And you do wonder, just like the lag time for all of the Fed rate increases to take effect, you do wonder what, when we have moments of peace or calm, is it just a case of
best.
Yeah, exactly.
Well, and one big question I have, and I was going to mention this to Herman earlier, is that we talk about, the banks that are not necessarily struggling with liquidity, but the stock price is down. So the question is, is there a problem? Is there an issue here? And I wonder whether our reporters have had any luck with getting some insights into how much that impacts consumer confidence. If the stock is tanking and the consumer is, embarrassed to pull out their First Republic credit card, is that enough to make deposit outflows increase? Paige, are you hearing anything about that consumer reaction in your reporting?
Frankly, I think that's kind of the question of the day, of whether what comes first, right? Sort of the chicken or the egg of, we see these sort of stock price, we see the volatility in the markets, and then do we keep checking in on deposit levels, and this kind of dinging back and forth between deposit levels and market continues. So I don't think we can even begin to try to answer those questions just yet, but it's sort of the continuing of asking those questions and monitoring and seeing and checking in with consumer confidence, I suppose.
It's just wild, like this whole concept of thinking about, bank runs in this day and age. Paige, good stuff. Thank you so much. Paige Smith, she's consumer finance reporter at Bloomberg News. They're in our bureau in Washington, D.C. Western Alliance shares, they're down about 38% off their lows of a decline of 61% earlier in the session. You've got PacWest down about 61% at its lows, now down about 44%. So we've seen them popping off. And if I look at the regional bank index, the KRE, the SPDR S&P Regional Bank ETF, it is down about 5%, but it was down nearly 10% earlier in the session. So down, but off their lows. All right, let's get back to world and national news. Nancy Lyons is on it in our Bloomberg 991 newsroom in Washington, D.C. Hi, Nance.
Thanks, Carol. In a trial that lasted several months, a jury in Washington, D.C. has reached a verdict in the Proud Boys trial concerning members' actions around January 6th. The leader of the group, Enrique Tarrio, was found guilty of seditious conspiracy along with 3 other members. That charge specifically targeted their coordinated efforts to prevent the peaceful transfer of power to Joe Biden. Well, there's now new reporting about Supreme Court Justice Clarence Thomas's relationship with a billionaire Republican donor.
The latest reporting from ProPublica shows Harlan Crow paid tuition for Thomas's grandnephew to attend 2 private boarding schools. Thomas was the boy's legal guardian. The news outlet cites a bank statement showing Crow paid $6,200 a month at Hidden Lake Academy in Georgia. A former administrator there says Crow picked up the tab the entire time the boy was there and also paid for tuition at another school in Virginia. ProPublica has already reported on undisclosed luxury vacations and real estate deals between Justice Thomas and Harlan Crow. In Washington, I'm Nathan Hager, Bloomberg Radio.
Ed Sheeran has won his copyright infringement case. The singer was accused of copying the Marvin Gaye classic Let's Get It On and writing his 2014 hit Thinking Out Loud.
We've spent the last 8 years talking about 2 songs with dramatically different lyrics, melodies, and 4 chords, which are also different and used by songwriters every day all over the world.
The New York case against Sheeran had been brought by the estate of Ed Townsend, who co-wrote the Marvin Gaye hit. A coroner says 4 people have been killed in the South Georgia city of Moultrie, including a fast food worker and 2 relatives of the gunman who took his own life. The Georgia Bureau of Investigation says there is more than 1 crime scene, including one at a McDonald's restaurant. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
3:40 on Wall Street. Stocks lower across the board. Apple after the bell. Regionals hit hard again. Let's head right over to the first word breaking news desk for today's afternoon call. Lots going on. Here he is, Bill Maloney.
And good afternoon, Charlie. U.S. stocks under pressure again about worries about those regional banks. Dow's currently down 260 points. S&P's dropped 22, and NASDAQ is lower by 33. The U.S. 10-year yield at 3.36%. Gold is higher by 10. Oil trading in the red. And Bitcoin is higher by 1.3%. Among the main 11 S&P sectors, only real estate utilities were in the green. And leaders to the upside, the Dow, Intel, and Amgen, while Disney and American Express led to the downside. And regarding those regional banks, PacWest plunged 47%. Western Alliance sank 36%. And after earnings, Qualcomm fell 5.5%. In other news, Microsoft is helping finance AMD's expansion into AI processors. And wrapping things up, Apple reports after the bell. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney. And to hear live breaking news over your Bloomberg, type Squawk, S-Q-U-A, on your Bloomberg terminal. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, we've got just under 18 minutes left in today's trading session, getting ready to wrap up the day of trading just before that monthly jobs report. We'll get that tomorrow morning. Let's get to it with our Drive to the Close guest. Mark Travis is back with us, President and Chief Executive Officer over at the Registered Investment Advisor, Intrepid Capital, joining us once again on Zoom from Jacksonville, Florida, where we understand, Mark, it is lovely in Jacksonville, Florida. It's not so lovely here. It's a little cold and gray again, but I hear it's pretty nice out there.
Carol, I think you should do what every other New Yorker's done and pack up and move to Florida.
That we can talk about later. I hear you. You're right. There's a lot of people moving there. Having said that, I am curious, in a week where I feel like we've had so many big picture stories, whether it's the regional banks, Fed policy, we're still talking about inflation, recession, we've got the other stuff like U.S.-China stress, Russia and the rest of the world. I feel like that's always top of mind. What's kind of top of mind for you? What do you think is the really big macro story that you focus on when you are stock picking, which we're going to get to in just a moment?
Well, I think, Carol, unfortunately, most people buy high and sell low. And so I try to resist that the best I can. I think we've definitely, as everyone on the program knows, had a reset in rates over the last now 14 months, up 500-something basis points. So, not that my compliance department likes me to say this, but I do think you're getting paid to wait much better than you have been in recent history. And so as a fund manager that owns stocks, bonds, and cash, and in one case just bonds, I think we're paid better now than we have been in some time. And I think we're closer to the end of the cycle than the beginning. Do I have some crystal ball here that tells me when? No, I don't. But I do think we've moved pretty fast and pretty hard. Maybe one of the first or second fastest increases in rates in Federal Reserve history. So it has lagging effects, as everyone knows, and we're waiting to see what those are. But I think there's opportunities out there if you're patient and have a longer than a next quarter time horizon, which I do.
So, Mark, what do you think it is that markets are waiting on? I know you don't have the crystal ball, but is there a specific, eco data point or earnings cycle that you think will indicate that we're at the other side of this?
Right, because what you say we're closer to the end, and you said you don't have that crystal ball, but that's a really good question. Like, what is it that makes you say that?
Well, because of, I guess, history, going back to the speed in which they've moved, I do say somewhat sarcastically, we're asking the people that caused the problem to fix it. And so we're now getting the antidote. But again, I think certainly the market's grasping for when does the Fed cut. I think that's probably farther out than maybe some or many.
Right.
But again, when I look at some of the companies I'm happy to talk about, and it's the compounding they've had over a long period of time is really quite phenomenal.
Well, let's get to it, because that's one of the things we do like that you come to play with and actually talk about some of the names that you do like. Garmin is one of them, $19 billion in market cap. It's up about 10% year to date. Reported earnings early yesterday. The stock was up about 3% on the news. You saw Barclays and Morgan both raising their price targets on the company. Were you buying off of earnings or beforehand? Talk to us a little bit about your positioning in this one.
I've owned it for prior to that announcement, and I'm a patient holder, and I think it's a great business. But again, and you may have seen in the last, I don't know, 3 or 4 weeks, a column in the Wall Street by Jason Zweig talking about compounding of companies and how the human mind has a hard time getting around something that's compounded 1,000%. But if you look at Garmin, for example, I believe it went public in the early 90s with about $200 million in revenue, and today it's doing run rate probably $4.5 billion in revenue. They had 200 employees, and today they've got thousands.
Yeah.
And the stock price reflects that. So again, part of what I like is the family still ownership. The co-founding families have a substantial stake. In the environment where financing is hard to come by, they have billions of dollars in cash to buffer them and or acquire something or, opportunistically buy back shares. So all those factors are reasons why I'm interested in that equity.
Yeah, you mentioned buybacks, so I am forced to ask you about Apple today. Do you have any take on Apple's previous positioning when it comes to buybacks, and what will your kind of analysis be if they do what's expected and continue to push forward on buybacks with some of their excess cash?
Well, I guess I would answer that in an indirect way, which is I was very much against the tax imposed on buybacks of 1%. And now the SEC's voted to make the kind of regulatory burden around that even higher. I'm against all that. I don't have a real strong opinion about Apple, but, you can certainly look at their balance sheet too and go, why isn't my dividend higher? Why aren't you buying back more shares? But again, it's one tool in the toolkit for, executive suites to make in terms of trying to grow their business and allocate capital. And I think now politicians are trying to take that away, which, again, I'm against.
Hey, I do want to get to another name that you like, Watsco. It's an HVAC company, $13 billion market cap, quite a run this year, up about 34% year to date. About 12% of the float is shorted, and we did see the stock rally 8% to a record high when it reported earnings on April 20th. It's got about a 3% dividend. What's been your story on this one, Mark?
Well, I think this was a cultural story, and it's also, again, a family business. In this case, a father-son business, family members, a NAMAD family out of basically Miami. And I think the perception of some is they're going to be subject to a slowdown in housing, but they're really strong in their replacement cycle. And they're very careful in their acquisitions, but they also just culturally have a very long tenured management team. They, have an ESOP that's been very effective. And again, I'm kind of paid to wait. They too have very unencumbered balance sheets. So with Garmin and Watsco, I can collect a 3% dividend, and I'd rather take that than a 10-year treasury at 3.5%.
I hear you, right? It's all about, you got to kind of compare it and what's the return on some of the different assets. Mark Travis over at Intrepid Capital, right here on Bloomberg Business Week. You are listening and watching Bloomberg Radio.
your company news headlines on Bloomberg Radio.
It is 3:53 on Wall Street from Bloomberg World Headquarters. I'm Charlie Pelletan. We are just minutes away from arguably the most closely watched earnings report of the week, and that is Apple's. Second quarter results due after the close are expected to show a 4.8% drop in revenue and a 5.8% slide in earnings, according to consensus analyst estimates. Tom Forte is senior research analyst at D.A. Davidson.
I think it's going to be a reminder that Apple generates a ton of free cash flow, and if you're not going to buy the stock and Warren Buffett's not going to buy the stock, Apple's going to buy the stock. So I expect another increase in their share repurchase plan. When you couple that with their dividend, though the dividend yield's still quite modest, they're returning a lot of that free cash flow they generate back to shareholders, and I think that's contributing to the strong performance for the stock.
Indeed, that stock up 27.6% year to date. Today, however, a lot of weakness across the board, techs in specific, but we have got Apple shares lower today by 1%. Sources tell Bloomberg Microsoft is working with Advanced Micro Devices on the chipmaker's expansion into AI processors, part of a multi-pronged strategy to secure more of the highly coveted components. We do have Microsoft shares higher by 0.4%, AMD up 6.2%, Qualcomm after earnings down 5.4%. Regional banks tumbling again. PacWest stock we're talking a lot about down by 51%. Western Alliance down 39%. Those are the company stories we're following this hour, and this is Bloomberg.
This is Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
All right, everybody, you are listening and watching Bloomberg Business Week. We are on YouTube, we are on Bloomberg Originals, and we are, of course, on Bloomberg Radio. Carol Masser, Tim, on leave, and with me is Bloomberg Quick Takes, Madison Mills. And Maddie, it was so funny. Here we were talking to Mark Travis over at Intrepid and talking about Florida. Maybe we should move there. And lo and behold, our story on the Bloomberg by our Michael Smith about billionaire tech investor Peter Thiel said he's reluctant to move his operations to Florida from Silicon Valley because housing prices have soared. Like, this is an issue for him?
I mean,
get real.
It's got to be more of a kind of philosophical thing, but I think that that's originally why he was talking about moving there, which he's calling, again, tough because of rising housing costs, which is just interesting because we know that housing costs have gone up in California more than any other state. But he did talk about on a podcast, this is with Barry Weiss on her podcast, he said, if you buy a house in Miami today versus just 3 years ago, you're paying 4 times as much for a monthly mortgage payment. So that's what he's talking about when he's looking at the difference between California and Florida.
It's kind of funny. Not so funny is the stress that we continue to see on the regional banks. And I just want to mention a headline that crossed the Bloomberg. This has to do with big banks to pay more to refill insurance fund under an FDIC plan. And again, forgive us, it's just a headline crossing, so we'll look for some more color on what that means. But this has to do, I'm sure, with the insurance fund that is used to help, whether it's in the bailing out of banks or using money to shore up banks specifically, or whether or not you have takeovers. So big banks to pay more to refill the insurance fund under the FDIC plan is very indicative of the time and the environment that we are in right now.
Absolutely. And then we've got this other headline coming through that smaller banks with less than $10 billion in assets will avoid fees as well, Carol. So we're just getting that in, but yeah.
And a little bit of a right-through on this story. The U.S. is poised to exempt smaller lenders from kicking in extra money to replenish the government's bedrock deposit insurance fund and instead saddle the biggest banks with much of the bill. So the FDIC planned to release as soon as next week a highly anticipated proposal for refilling its deposit insurance fund, which was partly depleted by the failures of Silicon Valley Bank and Signature Bank. This is according to people familiar with the matter. Smaller lenders with less than $10 billion in assets would not have to pay, said those who were not authorized to discuss the deliberation. So again, a sign of our times. All right, you are listening and watching Bloomberg Business Week. Beyond the Bell starts right now.
Certainly, it's still hovering near lows for the last couple of months. Let's get you to the closing bell. Full coverage market right here.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And
right now. We are 2 minutes away from the end of the trading day. Romaine Bostic out in Los Angeles, California. Scarlett Fu in New York. We're counting you down to the closing bell, and here to take us beyond the bell. It's our global simulcast, joined right now by Carol Massar and Madison Mills. Welcome to our audiences across Bloomberg Television, Radio Originals, and those folks streaming on YouTube. Hey, guys. Another great day, interesting day, I should say, in the markets here. You kind of wonder what the next shoe to drop. Big jobs report tomorrow morning.
Yeah, big jobs report tomorrow. So, yep, we're going to focus still on the U.S. economy coming off of that Fed meeting yesterday. But again, it's regional banks that are front and center. Remain. I'm looking at PacWest. It is down about 51% as we speak. You look at Western Alliance, it's down about 38%. And we see the FDIC, just a headline crossing, that they're looking to really hit the big banks to refill their insurance fund because it's been depleted because of the failures of Silicon Valley and Signature Bank. So this is, according to people familiar, but a sign of the times we continue to see, though, stress, Maddie, in the banking sector.
Yeah, and again, pointing to that headline, Carol, as well, with lenders with less than $10 billion will avoid those special payments. So that's news on the terminal about the FDIC, again, as Carol said, planning to hit those big banks with fees. One thing that I'm also thinking about, Scarlett, is those Apple earnings coming out later today and whether or not that's going to support the idea of those tech growth stocks on the S&P 500 continuing to be a kind of safe haven for investors amid some of the broader volatility that we continue to talk about.
Yeah, and Apple being a really good example of, you know, a big tech company that has become a safe haven, but trading at much higher multiples than the other consumer staples. All right, let's get you the closing numbers as we close things out on this Thursday. You have an S&P 500 down by 0.8%. You have a Dow Industrials losing 0.9%, and the Nasdaq off by 0.5%. Again, we are waiting for Apple's earnings in about 30 minutes time. And of course, the big concern, as it has been the last few days, is really with those regional banks. You have the KBW Bank Index off by almost 4%. They've been falling by double digits when it comes to the likes of Western Alliance and PacWest and First Horizon as well. The headlines have just not been good, Carol.
No, absolutely. Once again, you know, Monday there felt like there was some calm after J.P. Morgan's takeover of First Republic, but we see that there continues to be stresses. As you mentioned, the regional banks really feeling it, down about 5% as a group overall. But look at the S&P 500, Scarlett. You've got most names in the index, 356 to be exact. On the downside, 146 actually gaining some ground. But again, you're seeing some fair amount of broad-based selling today.
Yeah, and you see that reflected in the sector performances too. This is 24 industry groups in the S&P 500, and only 2 of them are in the green. Let's start with real estate investment trusts, up by about 1%, and utilities, the safest of safe havens, prized for their dividends, along with REITs, both of those in the green. Everything else is red, including some more traditional staples like food, beverage, and tobacco, getting ahead of myself here, and software and services, which has become kind of a safe haven. On the flip side, worst performers, banks, consumer durables and apparel, and media and entertainment. Really disappointing numbers from Paramount.
Yeah, a lot of red there. So, okay, as for some of the gainers, AMD, this was a standout, certainly in the S&P 500, NASDAQ 100, up 12% at its highs today, folks, but finishing the day with a haircut, about half of that, a gain of about 6%, reported on Tuesday. Our steward noting that analysts have raised their price targets on the company since it reported 10, raising price targets by an average of 12%. And then you had the news that Microsoft is helping finance AMD's expansion into AI chips. So certainly a standout here. Datadog, up about 14.5%. Another gainer, top in the NASDAQ 100. It's a cloud software company. Reported first quarter results that beat expectations, also raising its full year forecast. So investors like those results. And then to a smaller market cap company, just under $1 billion. Talking about Lemonade, it was up about 28% in today's session. The company, an AI-driven insurance company, reported stronger than expected first quarter results and improved its outlook for adjusted EBITDA loss for the year. Keep in mind, 20%, over 20% of the float is shorted on the company, but so maybe some folks who are holding shorts got a little surprised by the upbeat earnings report, Maddie.
Yeah, well, I want to go back to Paramount, which you mentioned, Scarlett, on the close, down over 28% here. That's after earnings and revenue missing estimates, cutting their dividend as well, of course. And they're expecting to cut spending on streaming content and find marketing efficiencies as they integrate the Showtime cable with Paramount Plus's streaming service. And that's allegedly going to save them $700 million annually. But that is scary news for TV addicts like me and Scarlett, because it may mean less quality content down the road, and further indicates this question about whether streaming profitability is sustainable given questions about the ad market for streaming. And that might be one reason that Disney is also down on the day, a little over 3% there. Disney is going through layoffs right now, so that's something that the market was rewarding them for, but they also just launched one of their new ad-supported tiers alongside Netflix, so still some questions about the success of that moving forward. And then I can't end without talking about PacWest, down a little over 50% on the close after confirming it's weighing those strategic options. We've been talking about this all day, though they did say they've not experienced anything out of the ordinary when it comes to those deposit outflows. So that's something that we've been talking with our Herman Chan a lot about, and whether or not that might indicate some potential safety for these regional banks, Scar.
All right, and let's take a look at the yield space as well, because at one point the Treasury 5-year yield reached a 2023 low as traders ramped up their bets on interest rate cuts during the second half of this year. But you can see that that's turned around a little bit here, or actually we don't have that up, but right now the 5-year yield is currently at 3.3%. The 2-year yield comes down while the 10, the 20, and the 30-year yields inch a little bit higher. Let's also take a look at earnings, because we have results in the online travel space. Let's start with Expedia here, because Expedia's first quarter revenue just slightly higher than what analysts were looking for, $2.67 billion. Analysts were looking for $2.66 billion, and it did have a loss for the period, which was wider than expected if we're comparing like with like. Adjusted loss per share of 20 cents. Analysts were looking for 2.5 cents a share. Yet the revenue is pretty much in line, and gross bookings of $29.4 billion, slightly ahead of what analysts were looking for, $28.8 billion. So the stock moving higher in the after-hours trade at the moment. Carol, well, I'm also looking at Booking Holdings, a different company, but also in the same line of business, and first quarter revenue meeting estimates.
Yeah, and we're seeing Booking right now, Scarlett, down about 4%, at least initial reaction. And so we saw we're seeing some disappointment. We've got Lyft out as well, and I'm just going to go right to the sticky, if I may. Second quarter revenue. So they're talking about the outlook, $1 billion to $1.02 billion. The estimate out there is $1.08 billion. I'm guessing investors are going to be a little disappointed. This company has been certainly struggling to some extent. See second quarter adjusted EBITDA of $20 to $30 million. The estimate on the street was $48.7 million. Second quarter revenue, $1 billion to $1.02, as we mentioned. That is below the estimate. As we know, Scarlett, this is a company that has been cutting prices to bring in riders, and certainly that is having an impact. Lyft shares down about 9-10%. Romain, I want to bring you into this conversation because we're getting to the tail end of earnings. Lyft, Apple a little bit later on today, but you've been talking with CEOs, including the Hyatt CEO, really getting some great perspective in terms of what's going on in the economy and what kind of visibility they have.
Yeah, I mean, we talk about sort of the conversations you had a year ago when people weren't necessarily sure we were headed towards a recession. Everyone seems sure of that right now, that we are, if not in one, headed towards one. But you talk about the interview that Scarlett and I had a little earlier with the Hyatt CEO. He's serving a luxury market, and at least in his view, he's saying that that's going to hold up in an economic downturn. And there was a great analyst report out by the folks at Morgan Stanley just about 4 weeks ago saying the same thing. So there's going to be a bifurcation here, but it'll be interesting to see, though, if that bifurcation, meaning the folks who are able to benefit in this environment, is that going to be enough to sort of prop up the economy as a whole?
Right, and I think we're going to see that reflected in Apple's results as well, because even though it's slated to report a second straight quarter of falling sales, when it comes to its most high-end phone, which I think is now the iPhone 14 Pro Max, there's still quite a bit of demand for that. And of course, the average selling price of that unit is much higher than the rest of its the Apple lineup of handsets. So you'll see that bifurcation between the luxury goods versus the mass market goods, to the extent that Apple iPhone is a mass market good.
Right. Well, to your point, Scarlett, it's such an interesting indicator about the health of the consumer, right? And I just want to hit on DoorDash earnings, reporting revenue that beat analyst estimates. It rose 40% in the first quarter. And interestingly, customers placed 27% more orders in the 3 months that ended at the end of March. And the value of those orders also increased 29%. So really interesting to kind of look at that strength of the consumer and DoorDash continuing to kind of own this space of food delivery sales in the U.S., Carol.
All right, so we talk about people wanting to do experiences, go out and experience things. Live Nation, certainly in that category, coming out with their latest results. First quarter revenue, that is a beat, $3.1 billion versus the estimate of $2.26 billion. And if we take a look at first quarter adjusted operating income, also coming in better than forecast, $319.7 million. The estimate on the street was $213.9 million. So quick check on that stock, and we're seeing unchanged in the aftermarket, at least at this point, Romain.
Yeah, interesting numbers. The growth is phenomenal, and I actually had a chance to actually sit down with the CFO of Live Nation a little bit earlier, really just talking about not only what's driving that, but in his view, he thinks that's going to be sustained.
That'll be interesting to see how what kind of commentary we get from the CEO during the conference call. Just before we go, I want to bring you the results out of Coinbase. First quarter revenue, $772.5 million. Analysts were looking for $653 million, so that is more than a $100 million beat on that line. Trading volume at Coinbase for the first quarter was $145 billion. That was below analyst estimates of $147.35 billion. So the early read right now on Coinbase is that that first quarter revenue number beat is good enough for a 2% increase in the shares in after-hours trading.
All right, so Coinbase up more than 2%. I'm looking at Lyft shares down about 1.4%. Booking is down about 5.5%, and Expedia a decline of more than 1%. And of course, we're waiting for the big one, Apple, in just about 20 minutes time. So getting through some of the earnings. All right, guys, that's a wrap.
Carol, weren't you out here in L.A. just yesterday? How'd you get back home?
What happened? What did I do? What did I say? You didn't want to come back home to us?
I don't know. They told me you were going to be here next to me, and then I woke up this morning, just me.
I had to get home, baby. I had to get home. I had to find some sun because there wasn't any in L.A. All right, looking forward to the rest of your broadcast. Romain, of course, out there on the West Coast. And that is a wrap for our cross-platform coverage, cross-coastal coverage, if you will, Beyond the Bell. Radio, TV, YouTube, and Bloomberg Originals. We'll see you again.
Bi-coastal, too.
I said that, didn't I say that? We'll see you again, same time, same place. Actually down 13%. I think I might have said 1%, but I meant down about $1.50, and it's actually down about 14% in the aftermarket. So really a killing here. Let's get to it with our Bloomberg Intelligence senior tech industry analyst, Mandeep Singh, here in our Bloomberg Interactive Broker studio, going through his phone, going through the headlines. It's down 11%. What's up with this?
Well, so top line growth, you compare Lyft to Uber and DoorDash, we just reported. Like Lyft growing 12%, 14% is just not enough. And, you know, Uber had 30% growth in its mobility segment. You see the same with DoorDash growing 27%. And these companies have much higher base, you know, so Lyft clearly has execution issues. You see that in the plateauing of their rider base. You know, it's been stuck around 20 million for the past 4 quarters, and they had a CEO change. Yeah. But in a nutshell, I think they really are struggling with that smaller scale that they have, so they don't have that driver additions on their platform to drive more incremental growth.
But they were cutting costs, right, to hopefully increase ridership. Is any signs in this release of that?
I mean, that's the problem with this business model is either you need scale or you need to keep offering subsidies to bring more riders, to bring more drivers on the platform. Right. Even though it's an asset-light model, you need those subsidies. And once you start paring back subsidies, it hurts your frequency. Yeah. That's what we are seeing with Lyft, is the ride frequency has just fallen off.
So what does Lyft need to do?
I think at this point, you know, it's a $4 billion enterprise value company. I think all options are on the table. If I have to look at, you know, any company looking to do last mile delivery beyond ride sharing, Lyft's biggest mistake was it never expanded beyond ride sharing. In hindsight, everyone kept saying ride sharing is more profitable than food delivery. But that was a mistake because that's what DoorDash did. They bought a company in Europe to expand internationally. They, you know, branched out and started offering white glove services, you know, storefront. So they really expanded into adjacent verticals, whatever they could find. DoorDash. Same thing with Uber. They kept expanding, even though they were not profitable, and they got a lot of criticism for doing it. That was the right thing to do, because without scale, you just can't keep the marketplace up.
Because I was thinking, I don't even think it's fair to almost compare Uber versus Lyft, because it feels like they have very different business models. Is that the case?
Well,
or in just in terms of how Uber kind of keeps expanding some of the services it's providing to those on the platform.
It is, and they are all marketplaces. They're all marketplaces where you want to drive frequency by bringing more, like the riders need to have something that drives them to open the app every day. And look, there are no switching costs in this business.
Yeah.
If I find lower price on Uber, I'm going to take that.
No loyalty either.
No loyalty at all. So the way to drive prices lower is by scale. That's how you drive the ETAs down. That's how you organically build that frequency.
Can I just say, one of the cool things I feel like when, like Uber, if you order something, that something's popping up, hey, if you add this or you want to go to this place as well, you can do this. Like, they're very clever at trying to create or increase the velocity of your usage on the platform.
Yeah, and look, they are layering on ads now. So if you're browsing through the Uber app, they're going to show you some ads. That's an incremental revenue. Lyft can't do that because it's so transactional, and that too, the monthly active user is stuck at 20 million.
Yeah.
So they can't grow that user base, and that's where you can't even think of ads right now because you don't have enough frequency.
Right.
Can they win on competitive pricing? Because I hate doing the anecdotal evidence thing, but the only times that my friends are taking Lyft is when it's cheaper than Uber, which in New York City is pretty frequently.
It is, but I think what Uber has done well is they've created tiered pricing for really attracting all kinds of users. So if you care about price, you can find that kind of ride on Uber. If you want that convenience, you can find an expensive ride and a shorter ETA. Lyft just is struggling to keep that driver supply on the platform. And that's why the ETAs are going up. So, the user experience won't be as good because people don't want to wait if you're looking to take a ride.
So the wait time is higher, even if the ride time might be a little bit lower.
And the price may be lower, but the wait time is higher.
Well, right.
You're not going to do that, right?
And I have to say, I've got both on my platform, and a lot of times I'll be like, I'll compare prices, and I don't find that Lyft is always less expensive. And so I automatically go in one direction. All right. New CEO, this was a big quarter for him. He's obviously, cutting costs. He's doing different things. What does he need to do going forward? What do you want to hear from him, from somebody who follows this company?
A B2B partnership. He came from Amazon.
Yeah.
They need to drive that velocity and frequency. B2B partnership with Amazon, Target, any of the retailers would give it. So Lyft really needs to branch beyond.
Like what? Like say, hey, Target, we'll deliver. Like people can order and deliver for you?
Yeah.
Really?
Yeah. I mean, Shopify just got out of their delivery business this morning because that wasn't profitable. So you are finding there will be fewer companies that are left in terms of last mile delivery because they don't want to compete with Amazon.
Right.
That's your bet in terms of partnering with Amazon as opposed to competing.
Is there an acquisition too that they should be making, or no? Is it more about partnerships?
I think partnership. I mean, what's in it for Amazon to buy Lyft? So everyone is coming to them to partner, and I think they wouldn't want those.
Ouch.
Yeah. So I think partnership is probably better for Lyft, and Amazon just has the network, really.
That's so interesting. Do you have any big questions still that you are looking to get answered on any earnings call?
Yeah, I think the key to me is what is he going to do beyond cost cutting? Really, I mean, there is a lot you could argue you could do with last mile delivery, because there are a number of areas, and that's where, having a network is powerful. They have the data, but at this point of time, really, they need to act fast in terms of driving that frequency, because Uber really is taking share, and they're taking share without spending on incentives. So Lyft's problem is their balance sheet. They're burning cash. They'll run out of cash if they keep burning $200, $300 million a quarter. They just have $1.5 billion on the balance sheet.
Is there room enough for two ride-sharing services as their core business, meaning Uber and Lyft, and one where Lyft can actually grow substantially in terms of market cap, revenues, and share?
I would say yes, this market could be a duopoly, but I would argue they will be more valued as logistics companies going forward as opposed to tech companies because the market is so fixated on profitability and running things without burning cash. That's why it's a little tricky for Lyft given its smaller size.
So you're saying like logistics meaning delivery? That is wild.
I love it. That's so interesting.
That's wild. Okay, good stuff. Thank you so much. Always. Mandeep Singh. He is our Bloomberg Intelligence Senior Tech Industry Analyst here in studio looking at shares of Lyft off their lows, but still down about 10% here in the aftermarket following their update on earnings. This is Bloomberg Radio.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It is 4:21 on Wall Street. We do check markets all day long here at Bloomberg. We are awaiting the latest numbers out of Apple, arguably the most closely watched earnings report of the week. We will have details as they become available. We are expecting Apple's numbers to drop just about 8 minutes from now. The Dow, the S&P, NASDAQ also lower today. Moments ago, though, we heard from Lyft, and it forecast revenue in the current quarter that was lower than analyst estimates, showing the challenges that the new CEO, David Risher, faces to turn around the struggling number 2 ride-sharing company. Mandeep Singh is a senior analyst with Bloomberg Intelligence, and he was our guest moments ago right here on Bloomberg Business Week.
Lyft just is struggling to keep that driver supply on the platform, and that's why the ETAs are going up. So, the user experience won't be as good because people don't want to wait.
And right now, we are looking at Lyft shares lower after hours by just about 11%. DoorDash reporting revenue that beat analyst estimates after hours. We've got shares of DoorDash pushing higher by 3.5%. First day out for Kenvue, that is the consumer health business of Johnson & Johnson. It climbed from its initial public offering price during today's debut session, up by 22%. You may not know the name Kenvue, but you certainly know its brands. They include Tylenol, Band-Aid, Listerine, and Nicorette. Stocks lower today. More drama in the regional bank area. S&P down 29, drop there of 0.7%. The Dow down 286, down by about 0.9%. S&P down 59, drop there of 0.5%. 10-year yield 3.36%. The 2-year 3.77%. Spot gold up $11 the ounce to $2,050. West Texas Intermediate crude down 0.1%, 68.53 a barrel. Cannot ignore the regional banks. Briefly, PacWest today plunged 50.6%. Also, shares today of Western Alliance down by 38.5%. And that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. We are waiting those earnings out from Apple due in about 6 minutes' time. So as soon as they cross the Bloomberg terminal, we will certainly bring them to you. In the meantime, we do want to check in with Dan Morgan. He's going to be here with us when those results come out. Dan, of course, a friend of the show, senior portfolio manager over at Synovus Trust Company. They've got roughly just shy of $22 billion in assets under management. Dan with us once again out of Atlanta, joining us on the phone. Excuse me. Dan, we are waiting Apple's earnings. A little tickle here. So while we wait for that, I do want to ask you about Qualcomm, because this stock down the most since November of 2022, but we did see this stock trading off about 5.5%. There was some disappointment over the results. I'm curious, they came out with a forecast that really indicated the smartphone slump that we have been seeing is going to drag on. What was your take on Qualcomm specifically?
Well, hi, Carol. Hi, Madison. Yeah, it was obviously this isn't a good way to kick off to get ready for the Apple report, right? Because we know that Qualcomm, we've talked about them in the past. About 25% of their sales go into chipsets that they make that go into the modems for the iPhones. And what really was kind of disturbing was the QCT, which is their chipset division, which makes these CDMA-based chips that they sell. Their guidance going into the upcoming third quarter was pretty shy of what the street was looking for. So the guidance was 6.9 to 7.5 billion. The street was at 7.8. So that gives us a kind of preliminary indication that sales have been weaker than anticipated in terms of drawdowns of inventories, especially in that chipset segment, which does sell directly into Apple. So we don't know, Carol and Madison, if this is kind of a ripple effect of what we're going to get here in a minute, which is going to be the second quarter Apple results rolling into this Qualcomm report that we're getting, a little bit ahead of the results hitting the tape on Apple.
Can I talk to you about Apple then, since you bring it up, Daniel? I mean, I wonder to what extent you've heard of investor concern that, all these buybacks can be used to hedge against slowing iPhone production. Because, what's the longevity of that move?
Well, Madison, you're giving up all Apple's secrets here. So whenever the stock languishes, this is historically speaking, and when iPhone revenues are flat and the other hardware categories are struggling, Apple has the ability, as you know, they have about $165 billion in cash to go out and increase their dividend. Matter of fact, they're supposed to increase it on this upcoming second quarter to about 98 cents a share and increase their share repurchase program. They're expected to grow that from $405 billion to $495 billion. So as your listeners know, if you're able to increase your dividend and lower the number of shares in your denominator of your EPS calculation, you're able to grow earnings on basically flat growth. And they've done that in the past. They've done a lot of financial engineering. They've split their stock like they did back in 2014. Everybody went crazy for it. So you're right, Madison. If these earnings aren't good, they'll just come out and announce all this great things they're going to do with all that cash they have sitting in the balance sheet.
All right. So having said that, if you look at what the stock has done ahead of earnings, Dan, it's up more than 27% year to date. It's outperformed the NASDAQ 100, but if you do look at what we got from Microsoft and Meta, the bar is pretty high for Apple. And I do think about any kind of disappointment, causing a major reset in terms of what investors are really willing to pay up for this name right now.
Yeah, I think what's happening, Carol, is that we expect this second quarter to be basically flat to down. We expect guidance in their upcoming third quarter 23 to be slightly down. But everyone's looking ahead, right? We're looking 6 months, 9 months ahead, and the glass seems kind of half full at this time. And, everyone's looking for, these catalysts going forward, and that is, you always want to buy Apple stock 6 to 9 months ahead of a product launch. We know that the iPhone 15 is scheduled for September. They're also going to be coming out, as you talked about before, a new virtual reality headset that's going to compete directly against Meta. There's also enthusiasm about the installation base continuing to grow. They have 2 billion users, 1.5 billion users on the iPhone. Of course, they can harvest that through their service revenue, right? That's how they monetize all these users. So that's how the glass looks half full right now. And I think right now, guys, everyone's looking ahead. Everyone's thinking, okay, we know this quarter's not good, but wait, it's going to be good in September.
Well, and it looks like just about a minute. Yeah, right, exactly. What are you going to do for me in the future? So about a minute before we get to Apple earnings, we're just watching the Bloomberg for when they cross. But Dan, one thing I did want to ask you, AMD, we saw that stock up more than 6% in today's session, 12% higher at its best levels of the day. But Microsoft helping finance AMD's expansion into AI processors. As we await those Apple's results, significance of that news, because it certainly seemed to give a little bit of a pop to shares of AMD today.
What's interesting, Carol Madison, is AMD was always behind Intel, and it seems now that they have just been ahead of the game in terms of bringing chipsets to the market to get ahead of Intel on some offerings that they've been delayed on. And this is just another feather in their cap in terms of what they've been able to do, and not only in data center and servers, but also in the CPU space for PCs. So things are really going well for them. Obviously, there's a downturn in the PC unit volume sector right now in terms of buying PCs after the COVID splurge. But I think AMD is much better positioned now than they've ever been. I've been following the company for almost 30 years.
But the idea that Microsoft is lending a hand and that connection, and we know Microsoft sent, the world on fire, with its deal into ChatGPT specifically. So that combination and partnership, big deal.
Well, what's a big deal, Carol Madison, is that in the past, Microsoft would write directly to the Intel microprocessor. You've got the numbers.
Yep, let's get to it. Apple crossing. Let's get to second quarter EPS, $1.52. Folks, that's 9 cents better than what the street was expecting. I'm looking for the second quarter revenue in total, $94.84 billion. That, too, is a beat. The estimate was for $92.6 billion. So, again, that's our red sticky. So that's a highlight. That stock is up about 3% in the after hours. Madison, you asked about buybacks. Apple to buy back up to an additional $90 billion in shares and raising its quarterly dividend 4.3% to 24 cents a share. So that is a big kick to the upside. Again, the stock up about 2% in the aftermarket. Let's go through some of the segments. Second quarter service revenue, $20.91 billion. That's a slight miss. $21.11 billion. That was the estimate among analysts. iPhone revenue, $51.33 billion. That's a beat. The estimate on the street, $48.97 billion. Greater China revenue, $17.81 billion. That, too, is a slight beat of $17.16 billion. Second quarter Mac revenue, $7.17 billion, a slight miss. The estimate was $7.74 billion. iPad revenue, that was pretty much in line, $6.67 billion. The estimate was $6.69 billion. And then you had wearables, home and accessories, $8.76 billion. The estimate was for $8.51. Again, the stock is up about 1.5% in the aftermarket. Dan, initial thoughts?
Well, obviously the big numbers that stand out to me, Carol and Madison, is this huge beat in iPhone revenue, because coming in this quarter, I had 48.97. They came in at 51.3, and that 48.97 would have represented a negative growth rate of about 3.2%. This is going to put them, I think, probably flat or even slightly up on iPhone revenue. I was looking for about 55 million units, so that's a huge number for them. A little bit of a miss, you mentioned, Carol, on the service revenue. That's a little bit of a surprise. That's probably about a 6% growth rate. And then it's kind of a little bit of a mosh pit here. Macs missed, but kind of in line with iPads. It's kind of a washout. But I think the street's going to zero in not only on that top line number in terms of revenues. That was a huge beat. Was it 94.8 versus 92.6? And a good beat on EPS. But that iPhone revenue is a bit of surprise, guys. After we got that Qualcomm number, right? We were kind of worried about that, but it looks like they were able to piece things together and put together a really strong quarter.
Well, they also expected, they had a 3% decline in revenue, the revenue number came in down 3% year over year, which was better than analyst expectations, but that's still revenue down, Daniel. So I wonder if you can talk a little bit about the impact of that and whether or not you see that as a win or a miss for Apple.
Well, Madison, as we said before, this quarter and next quarter, we're expecting slightly negative growth. So it's not too big of a surprise. Even though they beat estimates, it was a negative number. Again, if you were to look at some of these other FANG stocks that reported earlier last week, it was a very similar type of environment, right? It was kind of slightly up or slightly down. No one huge number beats. I think Amazon got at 5 to 10% top line growth in the next quarter, but we're all in single digit territory right now, unfortunately, with the FANG stocks, either plus or minus at this point.
Well, and again, we continue to see Apple shares in the aftermarket following their latest update up just about 2% here. I'm looking at the press release, Dan, and Tim Cook, Apple CEO, of course, saying we are pleased to report an all-time record in services and a March quarter record for iPhone despite the challenging macroeconomic environment, and to have our installed base of active devices reach an all-time high. We continue to invest for the long term, lead with our values, including making major progress toward building carbon neutral products and supply chains by 2030. And then they did say that, given our confidence in Apple's future and the value we see in our stock, our board has authorized an additional $90 billion for share repurchases, and then, of course, raising their quarterly dividend for the 11th year in a row. Commentary seems pretty safe, if you will. The macroeconomic challenges just gives us some idea and clarity. What is it that you want to know on the call today?
Well, what is the best way to jump your stock price up in FANG land? Talk about AI. So I would expect them to talk a little bit about their initiative in AI. So far, they've been a little bit quiet compared to Microsoft and some of the other FANG stocks. We know that their initiative is going to be using the phone as the apparatus to get, use artificial intelligence opposed to, let's say, a chat robot, so to speak, or like we're seeing with some of the other players. So I think we're going to get a little more hopeful color on that.
Because they've been the one company that really hasn't said a lot, right?
They haven't said a lot, yeah, Carol. They've been very quiet. I don't know if you saw the statistics of how often AI was mentioned on the conference calls with the FANG stocks last week.
A lot.
It's like 45, plus times, and of course the stocks were reacting. So
it's kind of like one of those earnings per share AI per year over year AI per, like every other word.
Exactly. And analysts are going to talk about it. They're going to ask about it and, hopefully get a little more indication too, guys, in regards to some of these new products. I mean, we mentioned iPhone 15 in September. We're looking for virtual reality headsets. So those are exciting things too, because new products always mean new growth. And the street's going to be really kind of zeroing on that. So I think new products and AI are the keys to this upcoming conference call.
On the AI thing, the thing being very, very big.
That's fair. We're still figuring it out.
The AI space. What would you specifically be listening to on the call to indicate that Apple is going to be a strong competitor to a Microsoft that's, for the moment, sort of been the front runner on the AI discussion?
Well, Apple's done a lot of things in terms of buying kind of like startups, kind of companies that are not big names like ChatGPT. You know, everybody knew about them before Microsoft infused that capital. So trying to get some more information from them in regards to what is their strategy. Is it to acquire smaller companies and kind of fold them under their umbrella, or are they going to be doing things internally? And the other thing, guys, is it more than just going to be some sort of artificial intelligence that's on one of their wearable watches that tells us what to do when we work out and what our heartbeat is and all that kind of stuff? You know what I mean?
Yes.
We're looking for transformational type of things that are like the Microsoft ChatGPT, where everyone's very excited about it. So I think that's where we got to zero in, because you're right, guys, Carol Madison, that it's been a very unexciting announcements coming out of Apple so far in AI, and they're a little lagging a little bit, I think.
Right, absolutely. All right, hey, Dan, thank you so much. Dan Morgan, Senior Portfolio Manager at Synovus Trust Company, joining us on the phone from Atlanta. Apple shares, just a quick rehash, up about 1.3, 1.4% in the aftermarket. Second quarter revenue, $51.33 billion. That's a beat. $48.97 billion. That was the estimate that the street was looking for. So stock's still popping, and of course, a big buyback and raising its dividend again. Let's get a check on world and national news. Back to D.C. we go, and Nancy Lyons. Hey, Nance.
Thanks, Carol. Former Proud Boys leader Enrique Tarrio and 3 other group members have all been convicted of orchestrating a plot to attack the U.S. Capitol in a bid to keep Donald Trump in power. A jury in Washington, D.C. found them guilty of seditious conspiracy. Attorney General Merrick Garland just spoke about the verdicts.
Today's verdict makes clear that the Justice Department will do everything in its power to defend the American people and American democracy. Since the January 6th attack, the Justice Department has conducted one of the largest, most complex, and most resource-intensive investigations in our history.
And Attorney General Garland says they are still pursuing cases connected to the January 6th attack. The National Football League is being investigated by California and New York over allegations it fostered discrimination and harassment in the workplace. Bloomberg's Jill Schneider with details.
Saying no institution is above the law, New York Attorney General Letitia James and her counterpart in California, Rob Bonta, announced today they have begun a probe of the NFL's workplace practices and culture. Both attorneys general cited a February 2022 New York Times report in which more than 30 former female NFL employees complained of gender discrimination and retaliation after they complained to human resources at the league. Last month, Jennifer Love, a former NFL director, sued the league for age and gender discrimination. Jill Schneider, Bloomberg Radio.
There are now more revelations concerning the financial ties between Clarence Thomas and billionaire friend Harlan Crow. ProPublica is now reporting the GOP mega-donor paid the private school tuition for a Thomas family member that the Supreme Court justice has raised like a son. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Carolyn Madison.
All right, Nance, thank you so much. Nancy Lyons in our D.C. Bureau. Now we want to head off to our Charlie Pellet with a check on some of the news after the closing bell. Here's Charlie with the Bloomberg Business
Thank you very
News
much indeed. Apple front and center, the story everybody is focused on. We got an Apple revenue beat. Apple raising its buyback and the dividend. Shares after hours up now by just about 1.2%. Dan Morgan is Senior Portfolio Manager at Synovus Trust. He was our guest moments ago right here on Bloomberg Business Week.
Numbers that stand out to me is this huge beat in iPhone revenue, because coming in this quarter, I had 48.97 that came in at 51.3, and that 48.97 would have represented a negative growth rate of about 3.2%. This is going to put them, I think, probably flat or even slightly up on iPhone revenue. I was looking for about 55 million units, so that's a huge number for them.
And again, after hours, Apple shares, they are up by just about 1.2%. Lyft forecast revenue in the current quarter that was lower than analyst estimates. After hours, we do have Lyft shares trading lower by just about 11%. More bank drama on Wall Street today, specifically those regionals. PacWest down 50.6%. Western Alliance Bancorp down by 38.4%. The Dow, the S&P, NASDAQ all declining today. Mark Travis is the president and CEO at Intrepid Capital. He was also a guest today on Bloomberg Business Week.
I think certainly the market's grasping for when does the Fed cut. I think that's probably farther out than maybe some or many.
10-year yield, 3.36%. The 2-year, 3.77%. S&P today down 29, drop there of 0.7%. The Dow down 286, lower by 0.9%. NASDAQ down 59, that is a drop of 0.5%. Spot gold up $10 the ounce, higher by about 0.5%. West Texas Intermediate crude up 0.1%, 68.69 a barrel. Bottom line, Apple rises after a revenue beat. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You're listening and watching Bloomberg Business Week. Carol Massar, along with Madison Mills, live in our Interactive Brokers studio on YouTube and Bloomberg Originals. Well, the Daily Wire is, quote, deliberately steering into the culture war. So says the co-CEO of the Daily Wire, the right-wing media company that is the 6th largest podcast publisher in the U.S. Who knew? That's more than Walt Disney and more than the Fox Audio Network and more than twice as many as CNN. And now it's looking to spread its content wings. This story, the upcoming new issue of Bloomberg Business Week on newsstands tomorrow, already online at Bloomberg.com/businessweek and on the Bloomberg. Let's get to it. Back with us in our studio, Devin Leonard. He's Bloomberg Business Week's senior global business writer. And I was kidding with you that when there's a wacky or weird story with some interesting players, I can just see like Joel and the team saying, all right, let's get Devin on this.
Take that as a compliment.
You should. I always look forward to your stories. So I am curious, what was the pitch to Joel, or did it come to you? Tell me what put this story on your radar.
I wanted to do something about, sort of the battle against sort of woke corporations. And actually, Danielle Sachs, the features editor and the editor on the story, and the editor on the Ben & Jerry's story I did, but she said, have you seen this commercial? And I was like, no, I haven't seen this commercial. And we watched the commercial, and then it kind of went from there.
Tell us about the commercial.
The commercials, it's just really amazing. It's for a product called Harry's Razors.
Which is a real product.
Sorry, excuse me. It's for a product called Jeremy's Razors.
But it's based on a...
Yeah, and sort of, you watch the commercial online.
We're showing some video for those who are watching Bloomberg Originals on YouTube.
No, this guy sort of drives up in, in a McLaren, gets out in this Gucci jacket, and all of a sudden he starts talking about, these sort of, transgender, stuff. And remember when boys were boys and girls were girls. And then he goes inside. He winds up. He says, Harry's canceled their advertising, with the Daily Wire, and because of a comment that one of the Daily Wire's hosts said about transgender people, kind of a slur. And but he's like, I'm going to start my own razor company, basically, and he fires a flamethrower at a bunch of Harry's razors and Gillette razors because he doesn't like the. Anyway, it's just like,
yeah,
but it's like, is this real or what? And literally, Danielle told me to watch the video, and I said, well, this sounds like a good story, but I had called the company. I was like, is this a gag? And they're like, no, but I really didn't know until I called them up.
That is so fascinating. Can you just explain to me what their definition of a woke company might be, and maybe some examples of things companies have done that make them woke?
Well, I mean, Madison. Obviously that's a term that kind of came out of the left, but it's been co-opted, by the right. So it's tricky to use the term, but basically, it's what. Their argument is sort of the major institutions in the United States have been co-opted, by the left, and so they're all out, as part of this whole sort of crusade to, get your kids to, to turn transgender, to, let criminals out of jails, and also, well, I've said it in there, to encourage policies to discriminate against white people. I mean, they talk a lot about things that are anti-white, but so going to the corporations though, I guess a lot, it's either featuring trans people in advertisements. So the Bud Light advertisement with Dylan Mulvaney's an obvious one, and then Hershey's had a Canadian trans woman, and also Harry's canceling ads over the sort of some of the anti-trans things that have been said in the Daily Wire. But you can go on and on. And, obviously, there's Disney.
Right.
So,
so tell us about this company. Who is the Daily Wire and the individual behind it, or who's running it, and what he's looking to do?
Well, there's really three people. There's a guy named Caleb Robinson, who's kind of a finance guy and who was I guess he was working for Ferris Wilks, who's a big fracking billionaire and who put up the original sort of seed capital for the company. But then there's also Ben Shapiro, who we haven't mentioned, but who is the most popular conservative podcaster in the country. Is 39-year-old kind of wonderkind or troll, depending on what your thoughts are. But there's also a guy who's the co-CEO named Jeremy Boring, and he is sort of the entertainment guy. And he's a guy who grew up in West Texas, kind of went out to Hollywood and kind of flopped, got into conservative politics, founded the Daily Wire with these three guys. It was sort of a right of Fox, a news site, and it's become a podcasting behemoth. They've also turned it into a big subscription-driven business, I should say. They practically doubled subscriptions last year, and now they want to get into they want to get into movies and TV shows and sort of become kind of a quote unquote anti-woke Disney.
Well, and anti-Trump?
Well, it's funny.
What is that?
Well, no. It's funny that you say that, Carol, because that was one of Ben Shapiro. I mean, he's sort of the face of the company. He drove a lot of the growth for a long time. He was already a somebody. When they founded the company in 2005. But he was against Trump early on. Boring was too, but obviously he wasn't sort of the face of the company. But so they they get attacked by a lot of Trump people, and to hear Boring tell it, that was going on right at the time they launched the company in 2015. He thought they was going to sink the company, but ultimately he thinks it helped the company. So they have this sort of reputation as as kind of more of a straight shooter, not quite as MAGA, but they have a bunch of Trump people on staff. So to say they're anti-Trump isn't really accurate either.
Okay, sorry.
No.
But I was trying to because going back.
No. But it's sort of they're playing kind of a funny, like, we're independent except for like those guys. Anyway, but whatever.
Well, it is. I am curious that those in the media industry, and it's not like they couldn't miss a fad or a trend or seeing a disruptor come in and do it differently. What do they say though about their plans to have do wider scope in terms of content?
Well, it sort of goes back to the whole culture war thing, where what I was saying, or I should say their approach that they're sort of like they have a for-profit model to fight the culture war, and their argument is like, look, half the country is basically conservative. I mean, just based on sort of the election results. Right. So big corporations have basically taken the position that this is really where their words, but they've embraced radical race and sort of queer theory, and knowing that it's going to offend half the country, but you're still going to have to you're still going to have to subscribe to Disney Plus, or you're still going to have to buy, whatever you're buying from Procter & Gamble. So it's like tough. We're going to take your money anyway. And their argument is like, no, right. We're going to provide an entertainment and alternative. We're going to provide an alternative in razors, right. Also chocolates. But we will be, but there's half the countries out there. It's a big market.
All right, we got to
hear them tell it. Yeah.
Read it, folks. Go online, get the magazine. Devin Leonard of Bloomberg Business Week. Thank you. This is Bloomberg.
company news headlines on Bloomberg Radio.
From Bloomberg World headquarters, I'm Charlie Pellet. Apple front and center. Shares up now by 0.6% after earnings. Apple did report second quarter sales that beat estimates, indicating that the iPhone is weathering an industry-wide downturn better than expected. It is also raising its buyback and the dividend after an initial move higher. We do have Apple shares up now by 0.6% after hours. Lyft forecast revenue in the current quarter that was lower than analyst estimates, pointing to the challenges that the new CEO, David Risher, is facing to turn around the struggling #2 ride-sharing company. DoorDash out with revenue that beat analyst estimates, showing that higher prices and a cloudy economic outlook are not dissuading customers from spending on takeout and other convenience deliveries. After hours, DoorDash delivering a gain now of just about 5.5%. PacWest Bancorp says core deposits have increased since March. It confirms it is in talks with several potential investors. More on the story from Bloomberg's Kimberly Adams.
Charlie, PacWest is seeking to calm markets as it becomes the new focal point of concern over the health of U.S. regional lenders. In a statement, PacWest said the bank has not experienced out-of-the-ordinary deposit flows following the sale of First Republic Bank and other news. The turmoil at PacWest shows how investor angst remains elevated after a string of industry failures and deposit outflows, despite Federal Reserve Chairman Jerome Powell's assurance that authorities are closer to containing the crisis. Charlie?
And that's Kimberly Adams reporting. PacWest down 50.6%. Also today, Western Alliance down 38%. Those are the company stories we're watching this hour, and this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenivek on Bloomberg Radio.
Hello, everyone. Madison Mills here with Carol Masser. We've got more Business Week to come, but first up, let's get a check on world and national news with Nancy Lyons in our 99.1 newsroom in D.C. Hey, Nance.
Thanks, Madison. The Director of National Intelligence, Avril Haines, says Russia's aggression in Ukraine has produced no clear-cut advantage to either side, and Russia may not have the capability to even launch a successful offensive.
Even if Ukraine's counteroffensive is not fully successful, the Russians are unlikely to be able to mount a significant offensive operation this year.
Haines was on Capitol Hill today briefing lawmakers about world threats. White House National Security Council spokesman John Kirby says Dmitry Peskov, a Kremlin spokesman, is spreading disinformation by saying that the U.S. was behind an alleged drone attack on the Kremlin.
The United States was not involved in this incident in any way, contrary to Mr. Peskov's lies. And that's what they are, just lies.
Kirby added U.S. officials do not have conclusive evidence that Ukraine was involved. Ukraine's President Volodymyr Zelensky has denied that his country carried out the attack. A coroner says today a gunman killed 2 relatives and a fast food worker in a rural community in South Georgia before then taking his own life. The coroner says the shooter killed his mother and grandmother at two neighboring homes, and then a woman at a McDonald's restaurant, all in the small city of Moultrie. A man accused in yesterday's mass shooting at an Atlanta medical facility waived his right to appear in court today. 24-year-old Dion Patterson has been charged with 1 count of murder, 4 counts of aggravated assault. The former member of the U.S. Coast Guard allegedly opened fire in the waiting room at a medical building, killing 1 woman and injuring 4 others. An investigation is underway at Churchill Downs just days before the Kentucky Derby. 4 horses have died, 2 on the track, 2 others as either a result of racing or training. Churchill Downs officials described the series of events as highly unusual and completely unacceptable. Blood work has showed nothing out of the ordinary. The Kentucky Derby is still set for Saturday. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Carol and Madison.
All right, Nance, thank you so much. Carol Masser and Madison Mills live in our Bloomberg Interactive Brokers studio on Bloomberg Originals and on YouTube. We want to go back to some of the big earnings, certainly, of the day, starting first with Apple. And that stock continuing to move in the after hours, off its best levels in the aftermarket, but still up about 0.9%. A couple of the key headlines, no doubt about it. Second quarter revenue, iPhone revenue specifically, was a big beat, $51.33 billion. The estimate was for $48.97 billion. And then, of course, Madison, there was what it had to say about a buyback.
Oh yeah, of course. We had the buyback news from Apple that we had already been anticipating, and we were speaking with our guest Dan Morgan about it. That this is something that we've come to expect from Apple, but the question is typically whether or not Apple is going to be able to use those buybacks to sort of hedge against any slowdown in iPhone purchasing and manufacturing. But it looks like, given the market reaction today, that news is being